there's a little shift underway here that I think we want to be mindful of.
We could see some positive action through the end of the year.
The heightened macro uncertainty means investors do need to be nimble.
We don't think we're getting any more rate hikes from the Fed.
It's far too early to be talking about easing, so just beware of that sting in the tail.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market this morning pulling back by 0.2%, but what a rally over the last week or so. 6-day winning streak on the S&P 500. Make it 7 on the Nasdaq 100. Bramo, over that period, the Nasdaq 100 up by more than 7%.
So here's the question. Is it durable? We were talking about this yesterday, and everyone was saying it really comes down to whether we get some sort of stability in yields. Clearly, there is a feeling of unease that we got yesterday from that, and some Fed officials have been pushing back, including one who we're going to speak to today. I'm just saying, are we going to hear more of that coming up?
Neil Kashkari in about 90 minutes' time of the Minneapolis Federal Reserve. Too early, too soon to declare victory.
How much is he pushing back, basically seeing the easing in financial conditions off of what Jay Powell said and saying, we'd rather err on the side of over-tightening than under-tightening. At a certain point, who matters? Does Neil Kashkari matter more than Fed Chair Jay Powell? Is this going to be a game of basically chicken, or is there something material here, as we heard from Citigroup's Andrew Hollenhorst, doubling down on the reaccelerating inflation kind of story?
Let's get to the pushback. Morgan Stanley, the pushback, JP Morgan, Mike Wilson over at Morgan Stanley. We find it difficult to get more excited about a year-end rally. Marko Kolanovic over at JP Morgan, falling bond yields, dovish central banks, quote, knee-jerk positive for equities in the short term, but the growth policy trade-off will remain challenging into year-end. That's the view from Morgan Stanley and JP Morgan this morning.
Problem is they've been wrong. They've been wrong all year. And this is really the problem when you've got investors who have gone into equities despite some of these warnings and have made bank. So at a certain point, you have to think, okay, if the companies are delivering and the earnings now are good, yeah, we've got no visibility until later, but hey, you better dance while the music's playing. And that, from all of the notes that I'm reading this morning and many of our guests coming up, seem to be saying just
What
that.
if I told you could be wrong, really wrong, and still bank hundreds of millions of dollars? We work.
The wrong business.
We work. At its peak, 2019, here's a company that gets valued in private markets at, $47 billion. And here we are 4 years later and the company's filing for bankruptcy. And in the meantime, we know, based on reports, that Adam Neumann, the founder of the company, has managed to take in hundreds and hundreds of millions of dollars. Bramo, that's unreal.
There's the question of how much he personally has profited. And then there's a question of how many broken business models are there out there that grew up during the pandemic with the executives taking in massive salaries while spending more than $1 for every dollar they took in because they counted on a free piggy bank that was the debt market that no longer exists. This, to me, is the question. We expected to see more of this. He might be the prime poster child for this, but we expected to see more of this at a time where you've got a company that locked in 10 to 20-year leases and then said, you know what, you can come here for a month at a time, pay us a salary, and we'll give you free beer and a ping pong table. So, I mean, at what point do you start saying this is an anomaly versus something that has maybe some indications of what's going on?
Are you suggesting he failed to elevate the world's consciousness? Is that what you're suggesting this morning? I'd make 2 points on this. I'd make 2 points. One, you're raising the right question. Have we fully realised the pain associated with taking interest rates from 0 through 5%? No. There's still more pain to come. It's going to come to the surface. We'll see it in different places. 2, we should do a special on the winners of ZERB. We should do a special on that, a full programme, who won ZERB. Adam Neumann's got to be a major candidate for winning that era.
I think there are a lot of people who are candidates. You just look at the stocks that are parabolic in the opposite direction during the pandemic, and you think, okay, who was bloated during an impression of another era? And who used this money to basically invest heavily with all of these ideals? And then, I'm thinking of Peloton, for example. But
Peloton,
I'm not thinking, there are a number of them, right, that came out with highfalutin concepts that drove their borrowing binges and didn't really drive profits.
We should do the special, shouldn't we?
I think that's
It's like
really
a nice
fun.
Christmas special. It'd be a good thing to do. Equity futures right now on the S&P 500, negative by 0.2%. Big run in this equity market, 6 days on the S&P 500. Longest daily winning streak since the middle of June. Yesterday, bond yields actually higher and equities did okay. This morning, they're lower by 5 basis points. Your yield on a 10-year here, Lisa, 459.34.
I love that yields can go up or down 9 basis points, and it's just a mild move at this point. Today, we get a host of Fed speak, including the Fed Governor Chris Waller, as well as Vice Chair for Supervision Michael Barr. We also hear hear from Fed presidents from Chicago, Kansas City, New York, Dallas, and of course, Minneapolis Fed President Neil Kashkari. He is speaking to us and Michael McKee at 7:30 a.m. Eastern Time here on Bloomberg Television, Bloomberg Surveillance. Again, I want to know how far he's going to push back against some of the enthusiasm that we're seeing in the market. We expected this to happen, and pretty much on cue, he came out yesterday.
Are there reasons for this Federal Reserve to be more tolerant of easing financial conditions, given that we've got a little bit of a rebalancing taking place in the labour market, unemployment shifting a little bit higher, wage growth a little bit more subdued? Neil Dutta of Renaissance Macro says yes. That's going to be a question a little bit later.
Surgical cuts. We can talk all about
that's
the
Neil's
surgical
phrase,
cuts with Neil later. The surgical sales, I'm curious about this. 1 p.m., U.S. Treasury is selling $48 billion of 3-year notes at a time, or the Treasury Department is really going to be front-loading a lot of these sales. We had 3 straight very bad auctions in the recent slate of auctions, which is the first time, or one of the first times that's happened since 2011. Do we see something different in this week? And today is election day, so if your kids go to public school, they are not in school today. Good luck with that. There is a question about whether these are relevant in any way, maybe the idea of social issues. What I'm personally interested is in what's going on in Virginia. Glenn Youngkin, who is a potential Republican nominee for the presidential election, is trying to flip the Senate in Virginia to Republican to get a sweep. So currently the House is Republican. If he can get that, there are going to be a lot of calls for him to run instead of President Trump, former President Trump.
It's amazing we're talking about potential nominees for an election that's less than 12 months away.
That's
for people who aren't even running. We're still playing that game.
I mean, anecdotally, is he not going to pseudo fundraisers with big people with big pocketbooks on Wall Street who would love for him to run? So let's see if he can come through on it.
Mohammed Yunus of Gallup's coming up on the program in about 15 minutes' time. Mohammed Yunus of Gallup is going to basically tell you how deeply unpopular both parties are with the electorate, and how many candidates are also deeply unpopular with the electorate. And I'm talking about the former president and the current president as well.
Nobody wants that election. And yet that seems to be the election that we have. So we're running out of room, as you point out. We're running out of room for other people to come in. So is this going to be the moment? I think that's what people are looking at. If he does get a clean sweep in the House and the Senate, turning to the GOP in a very blue state, or in a very purple state, I should say, do you end up with a lot of calls for Glenn Youngkin to be the Republican presidential candidate?
That conversation with Mohammed Yunus about 10 minutes away. In the next hour, we'll catch up with Bloomberg's Anne-Marie. Joining us now in this market, Ben Laidler, global market strategist at eToro. Ben, good morning, buddy. Great to have you with us as always. I want to start with this one, your words. Grounds for contrarian optimism. After the week's rally we've had, how contrarian is that, Ben, right now?
Oh, I think pretty contrarian. I think the rally you've seen over the last week has basically been short covering. It's basically this very bearish consensus caught completely wrong-footed by this sort of easing vice of bond yields and oil prices, which I think consensus thought was going to the moon. And we've seen that vice now work the other way. We've seen the relief trade. But I think from here, I think that easing vice, the end of the earnings recession, and this good fourth quarter seasonality, which includes still very poor sentiment, a year ahead repositioning rally, I think, is still to come as people refocus on a better 2024 and, throw in the restart of buybacks. I think it's going to be a good fourth quarter.
Ben, I'll ask you the question that we talked about at the top of the hour. Do you think there are reasons for the Fed to be more tolerant of easing financial conditions?
At the margin, but you're not going to hear it from them. They're going to have to walk the talk. They want financial conditions to stay, reasonably tight, to do their work for them. They know that if they give an inch, the market's going to take a mile, as we've seen over the last week or so. So they're going to do what they have to do, but I would take it with a grain of salt.
This is kind of a delicate question, but we were talking at the top of the show about Morgan Stanley, JP Morgan, other strategists who are still bearish on risk assets heading into year end, especially because of weakness to come. Ben, given Wall Street's bearishness, does that make you more bearish or more bullish?
It makes me more bullish at the margin, right? So I think that this poor sentiment that's out there is a significant ingredient of improving the risk reward. And just think about it for a second. This poor sentiment does two things. It means there's a lot of money sitting on the sidelines, which could come into this market if I'm right, things get incrementally better. And secondly, it significantly improves the risk reward. If we get more bad news, it's already priced in. People are already expecting it. And you don't need good news for this market to move higher. You just need less bad news And we got a huge reminder of that last week. We basically saw the unwinding of 6 weeks of underperformance in 1 week. I think that just showed to a lot of people the risks of being out of this market.
One thing that kind of defies my sense of reasonableness is that people keep talking about the excessive bearishness out there, and yet I'm looking at year-to-date gains on the NASDAQ of 30% and more than 15% on the S&P. It doesn't scream everybody's on the sidelines hiding under a blanket. So at what point do you see this bearishness in full force that you want to push against?
Yeah, so we have an investor sentiment index, which, to your point, is not at the level of sort of maximum bearishness that it was maybe 6-7 months ago, but it's absolutely below average. And in this sort of summer pullback we saw, it became, it fell below average. So, we're focused on the fundamentals. That's what's going to get this market higher. It's not going to be sentiment. That's the sort of icing on the cake. What we're focused on here is I think we've seen the top for bond yields. I don't think we're going to see oil sustainably above $90. We've had the end of the US earnings recession. And over the next few months, we're going to get clearer visibility on the Fed getting ready to cut interest rates. I think the Fed put is back. The economy is going to slow, but I think earnings are going to be resilient to that. And we're going to be discounting the Fed cuts that are coming. That's the bullish case for 2024. And I think people are going to start buying into that, or at least trimming these negative bets as we get closer to the end of the year.
Ben, that's not the bull case, that's the bull dream. The Fed puts back. Let's unpack that. Why do you think the Fed puts back?
Core inflation's at 4%, PPI is half that. What's the insurance policy for markets is if we get that hard landing, which I don't expect, but if we do, and that's the market fear because it's going to drag earnings with it, I think it'll also, it'll pull inflation down. And I think inflation is close enough that if you get that, the Fed can start cutting interest rates.
Okay,
and this is a huge difference from even 6 months ago, where if the economy had fallen off a cliff, the Fed's hands were tied. They're not tied anymore.
The Fed put traditionally was, in the sign of any weakness, the Fed had carte blanche to cut rates and to basically stimulate the economy. You're saying that the bar to cut rates has been lowered materially over the last, say, couple of weeks. Is that what I'm hearing from you?
No, it's been lowered materially over the last few months. 6 months ago, if the economy had fallen off a cliff, the Fed's hands were tied. It couldn't cut rates. Now it can. And I think that's a big difference. If you're a bullish investor like me, that's your insurance policy for there not being a soft landing and for me getting the economy completely wrong. I now have the Fed standing behind me. They weren't standing behind me 6 months ago.
Ben, when you say cuts, cut back to what? What kind of levels are you thinking about? There's a lot of people in fixed income having that debate and they really can't figure it out. Where are you on that debate?
I mean, inflation's not where it needs to be yet. Obviously, if the economy cools, it'll come down a bit faster. I don't think we're looking for dramatic cuts, but I don't think the world has completely changed from, you were talking about ZIRP earlier on. A lot of the structural drivers of that, whether it's debt, whether it's demographics, whether it's technology, they haven't gone anywhere. They're still there. So I don't completely discount it.
Ben Laidler of eToro. Ben, a lot to think about. We'll do that through the next couple of hours on this programme. Ben, appreciate it. What's changed between now and ZIRP? We can have that conversation. What's changed between now and last week? 2 weeks ago. 2 weeks ago, we're north of 5% on a 10-year yield, and we're talking about budget deficits, yield curve control at the BOJ, a lack of predictable buyers in the Treasury market, a loss of that in places like China, central banks, QT, the ECB, the Federal Reserve, all of that. And here we are sitting here saying with conviction that I think we've seen the highs in bond yields.
What's changed, in my opinion, is that the excessive short positions on Treasuries have basically been washed out, and we saw some repositioning there. The Treasury Department came out and threw the market a bone and said that we're not going to issue an incredible amount on the long end of the curve. We're going to really focus our issuance on the short end. And the Fed came out and wasn't that hawkish. And that was basically the insurance policy that the bulls are looking for, that they hold in their hands.
They are chewing hard on that bone. Let's put it that way.
It's getting its use.
Equity futures on the S&P, negative 0.25%. Next hour, 90 minutes away. Neil Kashkari of the Minneapolis Federal Reserve, live from New York City this morning. Good morning.
It's DC FinTech Week, and Bloomberg is on site. Live from Washington, Kaylee Lyon speaks with Grayscale CEO Michael Sonnenschein and others. Tune in for a special one-hour episode of Bloomberg Crypto. Bloomberg. Context changes everything.
We're announcing historic investment in America's railroads. I've been talking about this for a long time, I know, but finally we're getting it done. More than $16 billion, 16 with a B, billion dollars here in the Northeast part. Folks, too many people have been left behind in the past. They're treated like they're invisible. We're building an economy from the middle out and the bottom up, where no one's left behind.
President Biden in Delaware announcing $16 billion, with a B, in new funding for passenger rails. This all ahead of the 24 elections, where a recent New York Times poll has the president trailing Donald Trump in 5 key swing states. Do you know what the Amtrak shtick is about? Because I don't get it. I don't know anyone that loves Amtrak, apart from the sitting president.
Yeah, I'm kind of.
You can't explain that either, right?
I mean, everyone.
I went on a train a couple of months ago, and I don't get it.
Especially because if you come from, and I feel terrible because I am sitting in Tom's chair,
just
so
say it.
I'm going to just say it. But you come from the European train system that's really fast.
Not just it's Asia as well.
Here, honestly, you go anywhere. They're fast, they're on time, they're clean. Here they've got delays. They run on the same trains if they're express that the local ones do, which is kind of a problem considering that they're supposed to go faster than the other ones and they're on the same track, but I digress.
I'm an Amtrak guy. I just don't know what to take from that. What does that say about you if you're an Amtrak guy? I just don't get it. You come back from Switzerland and you say, I'm a Swiss train guy. I'm like, right, I understand. That means something.
I know.
But they're going to put $16 billion with a B into it, Bramo, so good news.
Well,
We'll make it better.
I hope that they do. I hope they build another track so that the Express actually can go express, and that's my dream for this country.
We'll talk about Amtrak, Joe, in just a moment. Let's get to the price action. Equity futures on the S&P 500. Negative here by about 1/3%. We are pulling back after a 6-day winning streak. You always read the stories, don't you, after you don't get day 7 or day 8. And I sit here and wonder, what are you expecting? This is going to move in a straight line, just carry on gaining. Then you've got to come up with the reasons why it's down today. It's down today because Neil Kashkari is not going to declare victory. I mean, come on, stop it.
But this is the reason why this market has been dizzying and very difficult to explain and very difficult to come in every day and address with a new thesis, because that seems to be what's happening. Wait a couple minutes and you'll come up with a new thesis and everybody will jump on board. At a certain point, that's how it's been over the past couple of weeks.
I want to get to a piece from Gallup, well worth a read. 2 major political parties remain unpopular in the United States. 56% of Americans viewing the Republican Party unfavorably. 58% saying the same thing of the Democratic Party. Mohammed Yunus, the editor-in-chief at Gallup, joins us now. Mohammed, help us out. I've been reading through this piece. Neither party is well liked. You guys have pointed out that maybe the GOP has an edge on certain issues. Can we just talk about the likability of both parties right now? Mohammed, how unusual is this?
Unfortunately, it harkens to your Amtrak conversation earlier. We're at a state right now in the United States when both parties are really not doing that great in terms of their favorability. It's nothing new, unfortunately. It's been quite a while since Americans had a favorable view of either party in the majority. We're also at a time where there's a record high of Americans saying that they'd like to see a third party in American politics. Of course, easy to say I want more. It doesn't necessarily mean that party would exist or actually be powerful. But we're also at a time, John and Lisa, where there's a high of people that identify as independents. And that is important, not only in the current moment, but also in our analysis over generations. What we find is that younger Americans today are actually sticking with that independent ID much further along their lifespan than previous generations, young folks. So certainly America is highly dissatisfied with national government. We've talked about that a lot. They're really, in some ways, most dissatisfied with both parties. That being said, today is a local election. It's really, I know it's so tempting for us to jump to 2024. Americans line up today to vote on local issues. And there's a huge difference in the way people perceive local government versus the national government here in the United States.
So, Mohammed, just explain that a little bit more. What is the big difference between the two currently?
Basically, trust and confidence. Americans have very low trust and confidence in the national government and national institutions. Perceptions of corruption are astronomically high. When you come to local government, though, people have a much more positive perspective on local government, whether it's the efficacy, transparency of local government and corruption, but also how they feel about their local governing officials. So Americans line up at the ballot box today. They're hearing a lot of echo chamber on the national, what this means for 2024. But really, what they're going to be focusing on are local issues. And the national conversation certainly will inform that. That's why things like abortion, things that implicate attitudes about big and small government, for example. They're on the ballot box. They will be discussed. They're going to be, they have been a focus of the campaign. We know in Ohio, there's a really big push on abortion. It'll be a really important weather vane in terms of whether or not Roe v. Wade's overturning has sort of faded, the impact of that has faded or is still with us.
I have to say, as you're talking about local elections and how different they are than the nationals, I think, well, they're probably not on TikTok, the local elections. They're probably not on Facebook. How much is it the social media echo chamber that polarizes people and gives them a worse than expected view of national politics in a way that local politics might be slightly immune?
I think that's a great point, Lisa. It's much easier to sort of check the BS, if you will, on a topic or an issue when it's about where you live. You know that reality. You have direct information from people you know. Where you live, you can talk to your neighbors, you can talk to your local religious leaders or community leaders. With national politics, it's a very different thing. It really tends to have now become sort of a war of the propagandas, if you will, of both parties, where truth is very hard to identify, but both sides are absolutely out there to religiously convict you, to religiously convert you to their worldview. So that's certainly a factor. But look, when it comes to 2024, and it's important for us to keep our eye on that, Mark, everything that we've done with regards to national elections really comes down to one thing. Americans focus on the economy. The economy is king. It's not only king, it's king, queen, and bishop when it comes to picking a president here in the United States. And that's going to be a huge factor in where people place their votes in November 2024. But as you all know, we are light years ahead from where that is in terms of assessing where the economy is going to be then. And that's going to be the major factor. When it comes to party advantages, the Republicans definitely have maintained their historic advantage in terms of Americans viewing them as more competent in keeping the country prosperous, keeping the economy booming, and keeping the country safe.
That said, how much are you looking to Glenn Youngkin today? Maybe there is going to be very much local issues that are decided, but the local issues have implications for whether Glenn Youngkin might be the Republican candidate for presidency. Do you think that's a stretch?
I think looking at the polls right now, that is a stretch. It's hard to argue that President Trump is not the front runner of the Republican Party. You know, every poll you do, every poll, what we've done, we don't do too many political polls anymore, but there are good polls out there. It's really hard to see somebody sort of astronomically jump ahead of him. Now, that being said, we haven't had a president in modern time that's facing the legal challenges that he's facing, and that's a whole other sort of curveball that's being thrown here. It's not clear exactly what his situation will be come real kind of rubber meets the road in terms of November 2024. But, you know, we heard from David Axelrod this week about the Democratic side. There's still a lot of movement in this race, and I wouldn't rule out any surprises or sudden departures on either side.
Up against the clock here, just to squeeze this in and finish where we started. You do mention in the piece that the GOP holds advantages on certain issues. Can we just breathe some life into that, Mohammed? Which issues specifically?
There are really three issues in specific. One is keeping the country prosperous. Republicans have a pretty sizable advantage, to Democrats in terms of perceptions of keeping the country prosperous. The other one is keeping the country safe. As you know, we're now very focused on two pretty significant conflicts across the world. Hopefully that doesn't become a reality for us here in the United States. But as Americans focus more on security issues, Republicans do have that advantage in our polls. The final one is who's most competent to handle the most important problem facing the country. And what's fascinating about that question is that the most important problem facing the country, as I have said on this show many times right now, is actually poor leadership and government. So Americans identify the low quality of national leadership as the most important problem facing the country. So it's the most important problem, the economy, and keeping America safe.
Fascinating. Great to catch up, Mohammed, as always. It's good to see you. Mohammed Yunus of Gallup. Mohammed Alerian writes in, I like Amtrak. Okay, so that's two people.
That's two. Okay. And what did you respond?
I'll tell you my response a little bit later. From New York, this is Bloomberg. Six-day winning streak on the S&P 500, taking a break, a pause, a breather if you will. Equity futures on the S&P looking like this. On the Nasdaq, negative by 0.25% on the S&P 500 and on the Nasdaq 100 too. What a run we've seen though. 6 days on the S&P, longest daily winning streak going back to the middle of June on the S&P 500. 7 on the Nasdaq 100. Bramo, that's the longest run on the Nasdaq 100, I believe, going back to January.
And again, this comes on yields going lower, which ostensibly were supposed to benefit the stocks. And then when they went higher, it also benefited the stocks. At a certain point, you start wondering whether they're the havens, as well as the aggressive stocks, as well as everything else, and whether that really is going to be the big performer in perpetuity.
Hardest job at Bloomberg. You know which one it is in Bloomberg News?
Not sure.
The daily market wrap. Because every single day you've got to say why we're up or down. The pressure to do that. That's this part of the game that I have a great amount of sympathy for people who's got to play it. Turn to the bond market. You're right. Yesterday, equities continued the run at the front end of the yield curve on a 2-year yesterday. Double-digit move. Higher, not lower. And yet we just shrugged. We're back in the 490s.
Again, it's sort of how far we've come and how much we've gotten distorted. Well, at least it's not 5%. So if it's 4.61%, it's not a big deal, even if it's up from 4.55%. At this point, I think the question is, how much do we need volatility to come down for benchmark bond yields, for equities to keep going with the rally? Is it that the levels have to keep going down, or is it just stability? Is it just a sense that we're not going to get, the table tennis or the, other things?
Help us define stability. Are we confusing a rally with stability? Because we had a big move out of nowhere in a couple of days, and then you had another big move yesterday. Have we really got stability in the bond market? Yes, we've got yields coming back down from the highs of the last few years, but have we got stability?
If yields go between 4% and 5%, is that considered stability? I think that's a question, right? If you know that they're going to be trading in a range, albeit a 1% range, is that in and of itself enough to give people the confidence that at least you're not going to the moon, and we're not going to have runaway inflation, and the Fed's not going to hike rates to 7%, right? I mean, basically, if you're counting on that kind of model, ignore the noise, invest long term, and just basically call it a day.
Let's see how these auctions go. Lisa went through them. $48 billion of 3-year notes. Bramo, $40 billion of 10-year notes tomorrow. Then it's onto the long end of the curve, 30-year maturities. I think we get about $24 billion worth. Where do you think the test is on the curve right now? Front end, further out, 10s, 30s, where?
10s, 30s, very much so. Okay. Because right now I think the question is, did the Treasury Department do enough to give people confidence that they weren't selling so much more debt that they would distort the curve dramatically, that they would actually cause the premium that investors charge to own this debt to go up that much more? If you see very orderly auctions, could that turbocharge a rally into year-end that gives the Ben Laidlers of the world a lot to chew on?
Ben Laidler was more than bullish. That was dreamy-like stuff going into next year. Ben Laidler talking about the return of the Fed put.
That to me,
I have not heard that from anybody.
That
the return of the Fed put
was kind of shocking. The idea that the Fed's going to be holding the hand of investors didn't seem to be in the lexicon of anybody that I ever talked to over the past 6 months, because everyone's been saying we are not going back to the regime that we used to be in. He was also pushing back on that. And there are people under the hood that still believe in the transitory story, however many years after it's kind of been debunked. So here are the different questions as we head into year end and people are trying to hook into which narrative to lead off their columns with.
I guess by definition, if you wait long enough, everything is kind of transitory, or most things anyway.
It's very philosophical.
Maybe, sure.
It's existential.
That's the extent of my philosophical ways this morning. The 10-year yield, 461. The 30-year yield, 478. Let's finish on foreign exchange. Turning G10 upside down. Everything weaker against the dollar yesterday off the back of those high yields. In the FX market today, that dollar strength continues. 106.76, Lisa, the euro, negative 0.4%.
The euro can't get away from this, and the ECB is coming out and trying to say an inverted yield curve doesn't actually mean recession and that this time might be different. The bottom line is the European economy is doing a lot worse than the U.S.'s economy. You can cut it whatever way you want it. That has been the story, continues to be the story, and there's nothing that we're getting that really pushes against that.
That's your market wrap. Under surveillance this morning, UBS reporting stronger than expected client inflows and saying it has already met its goal for reducing expenses this year. The Swiss lender reporting its first quarterly loss in 6 years as cost to absorb Credit Suisse came in at $2 billion. I think we're shaking off those numbers, Bramo. The stock is higher by 3.3%.
So I'm looking right now at the net new money coming in of $22 billion, including $3 billion at the Credit Suisse unit. And I'd like to get a better understanding of what exactly this money is, right? Is this new clients? Is this Credit Suisse clients that are coming into UBS and then new money coming into Credit Suisse? The integration, still so many questions, especially as we hear from really good people who have yet to be integrated into UBS and still cuts to come. So the integration still very much in question. That said, stability is a plus, and you're seeing that today in the stock.
Looking for stability elsewhere, WeWork, filing for bankruptcy. listing nearly $19 billion of debts. The co-working company saying it had entered into a restructuring agreement with creditors representing 92% of its secured notes. The company had once been valued, only back in 2019, at $47 billion. Now, Adam Neumann is gone. Long live Adam Neumann. In this statement from WeWork, this quote right here, now is the time for us to pull the future forward by aggressively addressing our legacy issues and dramatically improving our balance sheet. We're pulling the future forward.
All right. So there's a lot here about the euphemisms and the sort of spirituality of going to the office every day and sitting down behind a desk. There is a question about how much this was an era that came in 2016, 2017, 2018, 2019 that's been killed off by the pandemic and the inflation. And this really is, yes, Adam Neumann is the poster child. But remember Juicero, this company that sold $699 juicers that attached to your phone and had all these, highfalutin concepts. And then they found out that the pouches you could just squeeze with your hands and it had as equal of an effect. But there's a question of whether some of the highfalutin discussions are kind of getting lost in the reality of a cost of money that is something, not nothing.
I just wish I could have been a fly on the wall on some of these pitches. Think about Peloton. Yes. We're going to strap a tablet to an exercise bike. We're going to build a community. It's going to be a community, Bramo, that you're going to want to be a part of. And then because of the Internet of Things, we're going to connect to lifestyle, healthcare. We can go all over the place with this. It's going to be a key feature of your life as you grow older and look to stay healthier.
You missed your calling in life. Here, the problem is, I actually admire people who thought of the Internet of Things as sort of elevating us all as humans and connecting us and creating our own communities. And it sort of is this concept that is divorced from sort of the baseness of capitalism. And this was sort of, people who grew up and graduated from high school in 1994, early 1990s usually, sort of in that era. And it seems to be fading with the reality check of making money. And that's sort of the problem.
Bramo, the conclusion. When you take rates to zero, just on average, people lose 50 IQ points. Okay? I think that's what happens.
Well,
in the world of VC, that's what happens. It's like you lose 50 points across the board. On average.
I think Howard Marks would agree. I think there's this point of discipline. I will say the bigger question with WeWork is now they have more than 750 buildings with leases in it. What happens to that? I mean, the consequences of the loss of those 50 IQ points, might be a problem.
We get smarter as rates go higher. Okay, that's what I believe.
Do you feel smart?
I don't know if I do. I hope VC does.
Yeah, exactly.
Minneapolis Fed President Neil Kashkari saying the risk of over-tightening monetary policy is preferable to doing too little. In an interview with the Wall Street Journal, Kashkari saying, quote, I am not ready to say we're in a good place. Under-tightening will not get us back to 2% in a reasonable time. Kashkari is going to be joining us in about an hour alongside Mike McKee, so look out for that conversation. We're going to start the conversation with Jennifer Mickion this morning, right there, the chief global economist at Capital Economics. Jennifer, do you think we took away the wrong message from the Federal Reserve last week that led to this big equity market rally and this big bond market move?
Yeah, it's difficult, isn't it? Because the Fed's trying to deal with what's going on at the markets at the same time as influencing what's happening in the markets. So I think there was a pretty clear message that the sharp rise in yields that we had seen was adding to the tightening of financial conditions, and that's absolutely clear. But on the other hand, by just making those kinds of comments, they've caused something of a reversal, which may mean that financial conditions are now not tight enough to prompt the reduction in inflation that the Fed needs to see.
Ben Laidler earlier this morning was talking about how the Fed put is back in play. Does that seem reasonable to you?
No, not really. I think that's going a bit far. I don't think the Fed's trying expressly to support equity markets or financial markets more generally. It has an inflation goal that it needs to consider, and of course financial markets play into that, and particularly the state of financial conditions. There's so much uncertainty at the moment about the length of the pass-through and how quickly you'll see this affecting the real economy. But what we know is that the increase in interest rates and the tightening of financial conditions more generally that we've seen in the US has never happened before without a recession following it. So the Fed needs to be very, very cautious about just how much further it allows that to progress.
Although there seems to be a shift over the past, week where people are thinking more realistically about surgical Fed cuts, what we are going to hear later today from Neil Dutta, or this idea that the Fed is back in play with respect to responding to weakness in the economy, responding to weakness in markets by becoming more accommodative. Do you think the bar has gotten lower just simply because there are more signs of weakness?
I'm not sure that. Do you mean the barter rate cuts?
Yes.
Yeah, I'm not sure that it has. And in fact, I think that this experience, central banks generally haven't experienced this kind of inflation for decades. And I think it's been a real eye-opener, just how far inflation has risen, how far core inflation, wage growth have risen in particular. And I think actually that means that the bar now for rate cuts is much higher. I think central banks have had a bit of a shock, and they're going to really need to see very clear evidence that labour markets are loosening in particular before they'll feel comfortable cutting interest rates.
Jennifer, I think there is some confusion still with this second paragraph in a statement that the Federal Reserve put out a week ago. And this line specifically, the tighter financial and credit conditions for households and businesses are likely to weigh on economic activity, hiring and inflation. Just how fluid is an assessment like that? Is that already dated, given the move we've seen in the last week? Is that taken account of the move we've seen over the last 6 months? Jennifer, what is that in your view?
Yeah, it's a good point. And yeah, as I said, the Fed's influencing markets at the same time that it's speaking. So it does mean that these communications quite quickly become a bit dated. But it's worth remembering that a lot of debt is over long terms. So the pace at which businesses and households need to refinance is relatively slow. And that will increasingly, we'll see over the coming months, that households with 10-year fixed mortgages are going to need to start refinancing. And then we'll start to see the effects of previous increases in bond yields coming through. So it's not so much about day-to-day fluctuations as kind of averages over the past 6 months and the pace at which they're passing through. Certainly the day-to-day has an impact, but we must bear in mind that these sort of these average rates are very important too.
I certainly don't want to ignore some of the progress we've made elsewhere, specifically in the labour market. It looks like we've gone through a real rebalancing. Jennifer, in your opinion, do you think we can take some comfort away from the data we've seen so far? Just the idea that wage growth is a little bit more subdued. We've still got this payrolls growth. We're still doing okay.
Yeah, that's right. In the US, I think that employment report was a real Goldilocks report, wasn't it? It's clear that there's some softening in the labour market. Wage growth is coming down in the way that the Fed would really want it to. But there's not a collapse. There's no sign of a collapse in the labour market, of a surge in unemployment rates. So this is just the soft landing, really, that the Fed was hoping for. I think the real caveat to that is that that's really always how these things start. And it may be that the next employment report and the one after that shows something more worrying. But fingers crossed for the time being.
Jennifer McKeown, Capital Economics. Looks like a soft landing until it's not. Neil Datta from Renaissance Macro with this to say. We'll catch up with Neil a little bit later this morning. Lisa, top line for him, for the Fed, the labour market is no longer a reason to be hawkish for the reasons we just described.
That is the reason why we maybe heard a shift in tone from Fed Chair Jay Powell. To get from that to surgical cuts, to get from that to, maybe the Fed seeing something that looks like a soft landing until it's not, is a distance. And that's actually what I want to hear from him. How do you know that the weakness that we're seeing in the labor market isn't just a normalization that's going to then plateau versus the beginning of a progression into weakness? The Fed doesn't want to go too far. Neil Kashkari is pushing against that idea that, this is just the beginning of more pain that's starting to cascade. Is there anyone else, or is he alone? Neil Kashkari of the Minneapolis Federal Reserve joining us on this program in the studio here in New York in about 45 minutes' time. Look out for that conversation. Look out for this as well. Coming up very shortly, we'll catch up with our good friend, our colleague Guy Johnson over in Zurich, following the latest numbers from UBS. That conversation just around the corner. If you are just joining us, welcome to the program. Equities shaping up as follows on the S&P. Session lows now. We're negative by 0.4% on the S&P 500 following a 6-day winning streak on the S&P, a 7-day winning streak on the Nasdaq. In the bond market, yields up big time across the curve yesterday, particularly at the front end. This morning, a little bit lower. We're down 3 basis points. Your 10-year, 461.41.
I think that's very encouraging to see that so quickly our clients are responding to our actions to stabilize Credit Suisse and to and to offer them the best of the combined organizations. Credit Suisse needed to be restructured, profoundly restructured. I'm comfortable that we can mitigate the painful part of the job, which is the social cost. But it's very necessary in order to create a business that is sustainable.
That restructuring is going to have a cost. That was the UBS CEO, Sergio Motti, speaking back in September. We can put a price on some of that in just a moment with Guy Johnson. Let's turn to the broader price action. On the S&P 500, equity futures shaping up as follows, pulling back down by 1/3%. Yields coming down 3 basis points on a 10-year, 461. We have to sit on this, Bramo. This is quite a turnaround from where we were a couple of weeks ago. It's a 40 basis point move. Can point to the data, Treasury funding, the Federal Reserve. Take your pick at the moment.
Well, this is the reason why I think a lot of people aren't really responding to 9 basis points up or down from here, because we've already moved 40 basis points, so 9 basis points looks basically stable. At this point, we're looking at the potential volatility. Honestly, I keep going back to the Treasury refunding agreement. I think that was really what keyed it off. And then this idea kind of edifying that move with weaker than expected economic data. There are other questions, of course. The Bank of Japan, sure. What's going on over there? The idea of just investors getting more stability and having a better sense that maybe we've seen a peak. At this point, though, the lack of conviction right now in markets is incredibly high. I mean, honestly, that's all I can say. And that's the reason why coming up with a narrative on any given day.
Oh, so difficult.
Good luck. Have a good time.
You can predict the future and still get the market wrong. Pull up that board again. Get to the market board again and look at the bottom of it. Do you know what stands out for me this morning? Oil. Crude back in the 70s, yeah, Bramo. You nailed it. 79 on WTI. Go back a month. Who's going to make that call that crude's going to be back in the 70s?
Usually crude prices spike after some sort of geopolitical risk. There were people at the very beginning of what transpired between Hamas and Israel that were talking about $100 a barrel oil, easily $150 a barrel. At this point, we don't even understand why that's not even on the table. Is it because of a lack of demand, or is this because people really are sanguine about the risks around what's going on in the Middle East? I would have a very difficult time believing the latter. The former is much more believable to me, that maybe demand is not coming in nearly as strong as people previously expected. Interesting. Crude right now, 79.57. Let's talk about UBS. That stock right now is positive over in Swiss trading by about 3%. We can catch up with Guy Johnson over in Zurich. Guy, walk us through the good news, the bad news, but let's start with the good news. Are they getting those clients back after the debacle that took place in Swiss banking in the last 9 months?
They are, and we're getting stabilisation, John, and I think that's really what the investment community was looking for from this set of numbers. This set of numbers has no comparison. This is the first quarter we've seen these two banks bang together, as a result of which you can't really compare it to any other quarter. The analysts don't really have a handle on their estimates, so any kind of comparison really difficult to do. So you kind of park that, and then you kind of look at what is happening under the hood, and they're making progress. We're seeing stabilization in terms of the client story. That is great news. That means that they can progress with the integration. They've kind of got everything on a more even keel. And that's now the big question, John, where we go from here. But we're not going to know that until February, when we get the full year numbers and we get Sergio Motti unveiling the big kind of 3-year plan, the strategy that he is going to deliver at this bank. So this is a kind of bridge set of numbers. It tells us that they are making progress. It tells us that they're on track. They've stuck to their 2026 goals as well, which is quite significant. And I think, to be honest, that's why the shares are rising in a down market today. Things are on track. This has the potential to deliver, and if it's on track, that's great news. But there are plenty of problems that lie ahead. They've still got a lot to navigate.
Guy, do we have a better sense of who they're keeping and who they're not, of how many of the staff of Credit Suisse are going to stay on as UBS employees?
This is one of the critical questions, Lisa. There is $500 million that's being set aside for key staff for retention payments to make sure that those people stick around, because you track it on a kind of daily basis. There's been this person, that person departing for other big banks. You've seen that kind of steady drip, drip, drip. They need to stabilize that. They need to have the key relationship managers in wealth, etc., sticking with this institution. So they're parking money to make sure that that does happen. That's one of the key areas that they do need to stabilize. If they're going to make progress from simply stabilizing the numbers to growing the numbers, those are the people that are going to do that. And they are making it very clear that they're going to have to pay up to make that happen.
There was some angst when this merger was originally announced, when the takeover was announced, that a lot of clients would previously have gone to both Credit Suisse and UBS to diversify their risks, and now are not going to just simply take all the funds that they had at Credit Suisse and put them at UBS with their other funds at UBS. Do we have any sense of how much that's coming to the fore, whether the diversification risk is a concern for institutions in the region?
I think... So I don't think we're quite there yet, but it is an issue. Certainly analysts are talking about it, certainly the bank are aware of it, that they are going to have to manage these different kind of pools. And how they manage that diversification process, I think, is going to be very difficult. You're absolutely right. People would see these two institutions as competitive and therefore as diversified. I think it's unclear at this point how that process is going to unfold. I think it's unclear at this point whether ultimately, therefore, the pot is smaller. But maybe it does get smaller, but then it grows. I think one of the key questions that I think analysts and clients, I think probably more clients actually, both corporate and wealth, are still asking themselves is, how distracted is this management team going to be by the process they're about to go through? Would I be better off at another institution while we go through this process? And again, we've got to stabilization. They've kind of hauled some of the money back in, but whether or not that money is still kind of figuring out whether or not it needs a better diversifier, whether it wants to stick with this institution as we go through this process, I think that remains unresolved. We've only just started this process. We're in the first innings. There's a long way to go. And I don't think, Lisa, to be honest, that the answer to that question is in any way clear at this point.
Guy, just to wrap things up and take a more continental, European, maybe even global view, after the events of the last 9 months, particularly in US banking, we've been talking for a while now about the prospect of more consolidation. We're still waiting for it. Guy, what does that look like in Europe at the moment?
I think it looks like a long way off, John. Europe still really struggles with an integrated financial services sector. The banking union, I've been doing this a really long time. You've been doing this for quite a while. We've been talking about this for a really long time. We're miles away from it. It is still a patchwork of banks, banking regulations. So I think it's really difficult. But Europe really needs it. Europe really relies on its banking sector. It doesn't have deep capital markets in the way that the United States does. So this was a consolidation that came out of a crisis. I think a consolidation process that is driven by a desire to create bigger cross-border banking within Europe is a much more difficult process. And regulators don't seem particularly, and governments don't seem to be particularly on board with it. I would say, actually, John, we're going in the other direction. Rather than a consolidated direction, cross-border, I'd say we're going in the other direction towards a more national model.
Interesting. Guy, thank you, sir. Enjoy Zurich. It's great to catch up as always. Guy Johnson, our good friend and colleague. Feels like we've been talking about these issues forever, as Guy pointed out, a long, long time.
And I'm glad that you brought it beyond just continental Europe, but also in the U.S., because we've been talking about this as well. And why aren't we going to see some sort of acceleration of consolidation, especially after March? It hasn't happened. How much is this the fiefdoms of different banks and sort of not wanting to disrupt that? And how much is just the regulatory hurdles? Because banking is such a lightning rod for different regulators and for different politicians.
Slews. It's been 54 minutes. You haven't mentioned it.
It was not that interesting.
It wasn't that interesting.
That's the truth. I mean, it showed that maybe the worst is behind us, actually.
Okay.
If anything, it was actually more positive than a lot of people were expecting, and it was backward-looking, and suddenly the slews don't matter again. So congratulations.
This is the Senior Loan Officer Opinion Survey?
Yes, correct.
Okay.
Good job.
I mean, I tried to remember that 9 months ago and then just forgot it all again because we stopped looking at it.
That's exactly it. I mean, this was supposed to be the crisis moment. Something was supposed to break. It didn't. How much of this is because of the Fed backstop? We don't know. A pretty significant part of it. But we're not seeing the consolidation. We're not seeing the structural changes. We're just seeing the Band-Aids kind of over the edges so it doesn't have to percolate out too significantly.
Let's promo our next guest, Katie Kaminsky, Alpha Simplex. Katie Kaminsky, short treasuries through most of this year. Short treasuries. And every time we backed away from new highs for the year, I turn around and say, Katie, you're still short. And Katie would say, still short, looking for high yields. We've just had a 40 basis point move off the high, through 5% on a 10-year, back down to the 450s, 460-ish right now. Is Katie Kaminsky still short treasuries?
That's exactly the question I want to ask her. And also, is there some kind of momentum trade in the volatility, the whipsaw action that we've seen, or is it too noisy to follow the kind of trends that she's known for doing?
That conversation 5 minutes away. Katie Kaminsky of Alpha Simplex. If you're just joining us, equity futures on the S&P negative by about 1/3%. The bulls have been spoiled over the last week. 6 days of gains on the S&P 500, 7 on the Nasdaq 100. Bonds with a rally a bit. Yields lower by 3 basis points. Your 10-year 461.62 from New York City this morning. Good morning.
There's a little shift underway here that I think we want to be mindful of.
We could see some positive action through the end of the year.
The heightened macro uncertainty means investors do need to be nimble.
We don't think we're getting any more rate hikes from the Fed.
It's far too early to be talking about easing, so just beware of that sting in the tail.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a tone shift in the last week. Just amazing to see. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Lisa Abramowicz. I'm Jonathan Ferro. Your equity market this morning, negative 1/3% over the last week. Gains, day after day. 6 days of it on the S&P 500. Bramo, 7 days of it on the Nasdaq 100.
And we were talking yesterday, is this real? And people were saying it really depends on what happens to the yield space. I've got to say, a tone shift, yes. But every guest who's come on set with us pretty much either rolls their eyes or looks exhausted, because there's no sort of clear sense unless you have a conviction that comes true of what exactly is behind some of these moves and how durable they are. It is difficult to come up with a narrative behind the strength, because it will be a narrative that'll get disproven within a day.
Well, the consensus view right now is the Fed is done. Rick Reeder at BlackRock, the Fed is done. Even Andrew Hohenhorst of Citi says the Fed is done. Renmax Neil Dutta says we can discuss surgical rate cuts. We'll catch up with Neil later this hour. I love the tweets. The posts on X, call them whatever you want. This one here, the odds of an alien tea party in our backyard are as sensible as expecting a rate hike. That was Momentum Delta on X a moment ago.
All right, so there has definitely been a mood shift when it comes to the Fed rate hikes. There is a question, though, of whether we go full Ben Laidler and talk about a Fed put back in play and the idea of the Fed as sort of the insurance policy against a hard landing. I don't know that we can go to that level. There still is a lot to be seen. CPI, for example, which we're going to get in the next couple of weeks. All of the data on inflation, what I'm looking at when I look at these companies, they're passing through a lot of the costs, especially when you look at Starbucks and when you look at Big Macs and when you look at all of these basic things that people go out and buy. They're getting more expensive and people are still paying. So at a certain point, you have to wonder, how much is the Fed still worried about inflation, even if the market seems to have moved on?
It's frustrating, isn't it? But the Federal Reserve and economists will come on this program and they'll tell you, yeah, but the rate at things that are getting more expensive is less than it was a year ago, and that's good. And people are sitting at home. And actually, I think President Cook, Governor Cook at the Federal Reserve, talked about this yesterday, something we've brought up on this program before. People are unhappy with this because they want 2019 prices. It's no good telling people that inflation, the rate of price change, is lower than it was last year. That doesn't mean anything to anyone. They want 2019 prices, and they're not coming back.
They're not going to get them. Disinflation is not the same thing as deflation. It's sort of this economics lesson that's not really making its way through the political sphere, because a lot of people are looking at inflation and they're seeing how much more prices have gone up, not the rate of inflation and whether the rate of inflation is coming down. There is a key question, though, about whether we are going to reach some sort of stasis in inflation. It's not even clear that we're not going to see a reacceleration in inflation. I think that that's what people are keying into when they take a look at just how much pricing power a lot of these companies have. And the companies are able to keep selling a greater volume at a higher price.
So let's reset. We've had a big move over the last week. We're going to catch up with Neil Kashkari of the Minneapolis Fed in about 27 minutes' time. Are there reasons for the Fed to be more tolerant of easing financial conditions, given what we've seen develop over the last week? Isn't that the question right now in this market?
It seems like maybe the Fed, if they're looking at data that shows a softening economy, that maybe they are more comfortable with it. That is really the takeaway, and it seems to be the theme that we're hearing under the hood from a lot of different investors. I don't think there's a consensus, though, on the Fed, and I think that's why it is interesting to hear all the different Fed speakers.
Kashkari, less than 30 minutes away. Look out for that conversation. Mike McKee's going to join us as well. Let's turn to the price action. Equity futures on the S&P 500, negative here by 1/3%. A bond market rallied this morning, a sell-off yesterday. I can't keep up. I don't know how you're keeping up. Yields are lower by a couple of basis points on a 10-year. Lisa, 461.83.
Or is it even worth keeping up? The Fed speakers are all keeping up, though, and they're all going to be speaking today. We were just talking about Neel Kashkari. We are going to speak with him in about a half an hour time. The other Fed speakers include Fed Governor Chris Waller, Vice Chair for Supervision Michael Barr, also Fed presidents from Chicago, Kansas City, New York, and Dallas. All of them maybe can give us more insight into whether we are seeing some sort of softening in the economy that justifies an easing in financial conditions. Neel Kashkari is going to push back on that, and we'll get his view in just a bit. 1 p.m., we get the U.S. Treasury selling $48 billion of three-year notes. This is going to be an interesting kickoff to the auctions later in the week of 10-year and 30-year notes. Really key to see whether the calm beneath the surface continues in the Treasury market, as really this is sort of tested in terms of how much demand there is for these notes. And today, it is election day. Local elections, as we were hearing earlier in the show. I'm really focused, though, on Virginia. If Glenn Youngkin, the governor there, can flip the Senate of the state to the GOP, there's going to be calls for him to run for the presidential election. Other people are going to say, as Mohammed Yunus did, that's a stretch. And yet there's so many articles pleading for him to run, essentially. And people in the industry, it gives you a sense of just how popular the current election as it's setting up is really right now.
Some British sarcasm there, Bramo. That works. I appreciate that. We've got 6 months of this, haven't we? At least.
We're lining up. I mean, so many people are so unhappy with the lineup as it seems to be. And yet, is there any real discussion about how it is going to potentially change? Unclear. And that's the reason why I think it is important to watch this.
AMH, about 10 minutes away. We'll catch up with Anne-Marie down in Washington, D.C. in a moment. Joining us now, Katie Kaminsky, Chief Research Strategist over at Alpha Simplex. Katie, it's the number one question for us. Are you still short treasuries?
Yes.
Why?
Well, this is because for trend following, it's not just about a couple of days. It's really about persistent trends in the market. And I just want to point out, and this is something interesting, trend following signals have been net short for 9 quarters. This is the first time in many decades that this has been the case. And so the reason I'm pausing right now is because we've been saying short, short, short all year. And for the first time, it's starting to feel like we already got that short come through. What's next? What does the market do? Now buyers are coming in because yields are at interesting levels. They're probably thinking, maybe we finally hit that point.
Do you think something changed fundamentally to lead to that in the last few weeks?
I do, and then I think that the data has come out to support the narrative for investors. But I also think a narrative that has made sense to me is that investors have woken up to the idea that 5% yields, at some point there's a buying point where you think, well, there's a chance this could actually go down. And now you start to see this equilibrium occur where you're seeing the disinverted curve, which is something we've been looking for since the beginning of the year.
So, Katie, just to put a bow on this, are you now not short treasuries and actually starting to see value, particularly if yields get up to that 5% level in the 10-year?
So we're still short in terms of the overall frequency that we see signals, but we are seeing consolidation in those signals. So there's a reduction in that particular conviction. But what I will say is that I'm seeing more and more positive signals on higher frequency. And so I think on the shorter term, you're going to see more and more potential buying for treasuries. But I do want to remind everyone, inflation is still an issue. Rates could be higher for longer. So there's still really a good chance that we're going to see a lot of this volatility instead of a new trend per se that starts to emerge yet.
This raises this question of which particular data points are going to be the real action drivers, like what we saw over the past 10 days. Is it going to be basically every inflation read that we get? Or do you really buy into this idea that it's Treasury supply that's been dictating a lot of the volumes and a lot of the angst that we felt over the past month?
It's really interesting that you bring this up, Lisa, because we've been talking about this supply issue. I mean, how often do people actually talk about supply? They're only talking about it because I think people are trying to understand the equilibrium of where people sit and what yield should cost. I mean, what should be the right yield? And I think from our side, on the technical side, what we're looking for is potential breakouts so that we're seeing a steeper curve at some point. Our view is it's going to depend on really what happens with the economic data of whether we end up with tighter conditions or if we actually see something very extreme where we actually saw higher yields again. That to me seems very unlikely right now. But I think it's really a point to start watching every data point to see which direction the yield market is going to go, or which direction the yields go, because it's definitely an inflection point for me.
Katie, we're going to catch up with Neil Kashkari in about 20 minutes' time. I think we're all looking forward to this conversation. There is this second paragraph in the statement that they put out last week on tighter financial conditions. It reads as follows. I'm sure you're familiar with it. Tighter financial and credit conditions for households and businesses are likely to weigh on economic activity, hiring and inflation. Could you still write that same sentence today after the move we've seen in the last week? What's that a judgment on? The movement we've seen in the last month, the last 6 months? What do you think it is?
Well, I think the challenge is these numbers come in at different frequencies. Last week, we had a massive buying, but this could also be somewhat of a relief rally given how much movement we've seen downward, especially in equities. And let's just be honest, like I said, at a 5%, yields started to get exciting. People said, oh, I better get in there. So I think there's really still, this could just be the tip of the beginning of understanding how serious financial conditions have changed, and if it's enough to actually warrant a point where we might actually have cuts at some point earlier than some would have thought, like myself, who's been very pessimistic about rate cuts.
Katie, do you have a decent understanding of the conditions that would lead to those cuts?
Well, usually in terms of this, I think we'd have to see pretty severe deterioration in financial conditions to see rate cuts, given the mandate of the Fed and the fact that the other factors they're really focused on have not come down to their target level. So the fact that inflation is sticky and the fact that we have a strong workforce and that we have all of these conditions putting us in a good place, they have been pretty clear that they're going to keep us higher for longer until we can sort that out. On the other hand, if we had some sort of very severe drawdown or deterioration in credit that was clear, I think that they would have to act. So that, to me, would be the situation where we would see those rate cuts, is if you saw something in the credit markets or something in terms of consumers really struggling that would cause them to actually react.
So the Fed put still exists, just at a much higher pain point.
I would say probably yes. I mean, I think it always exists somewhere, but it's definitely moved a lot compared to what we liked in 2019 and before.
Kelly, let's finish where we started. Given the uncertainty you now have about your position, why maintain the short? That's what I'm going to walk away from this conversation scratching my head about. Why maintain the short when it can be as expensive as it was on weeks like last week?
So this is the point of trend following. Systematic trading is about not double sort of using your emotion in the moment. And I think what works with trend following is following the data. And we just need more data to know the answer. And over longer periods of time, it turns out the market is actually quite good at giving us indications of where things are moving. And it's particularly short-term movements where they disagree, where you want to lean on your own gut, but you shouldn't. Because that's what systematic trading is really about. It's about measuring and following the markets and allowing the markets to tell you what the market, where we're going, as opposed to sort of my own personal view, unfortunately.
Katie, thanks for the clarity on that point. Appreciate it. Katie Kaminsky there of Alpha Simplex. If you're just joining the program, welcome. On the S&P 500 negative here by 0.25%. Yields a little bit lower by a couple of basis points, 462.66. On a 10-year, let's call it 462.87 now, Bramo. Neil Kashkari, about 20 minutes away.
I want to hear what he has to say about this perception that seems to be trickling back to the market of the Fed put. It lives, it's alive, it's the Frankenstein of all things that were killed off, let's say, over the last couple of years. Does he like that, or is that counterproductive to the goal of the Fed right now?
We might find out in 20 minutes. Can I just say, if you want to read Neil Kashkari's stuff, and a lot of people complain about all the Fed speak through the year, and sometimes we do too.
Who could that be?
At the start of the year, he put out a blog about the 3 stages that he sees the Federal Reserve going through. Step 1, get rates up really quickly. Step 2, sit there and consider in a more careful, perhaps slower way, whether you have to do more. And then step 3, that's when you have conviction. Look around. Is inflation going back towards target? Can we reduce interest rates? That was a really useful guide for Fed policy through the whole year. And I wonder if we're at that point now where we're shifting from step 2 and getting closer to step 3.
We're also facing off with impatient markets that try to step over whatever kind of stage you're in and get to the next one. So it was very easy to see the pause after the hikes. it's harder to see what's on the other side of a pause.
Bramo, financial markets are like a child with a book.
Yes, I know.
Straight to the final chapter.
Yes, I know.
Maybe a little bit of the introduction.
Did you?
Of course.
Yeah.
This is a market that wants to trade the recovery to a recession we haven't had yet.
It's true.
But,
I read the last page too, and I'm not proud of it. I mean, honestly.
I'm immensely proud of it.
You are?
Yeah.
Okay.
How many books of those do you remember? Come on.
Well, I mean, come on. I just kind of feel guilty.
It's DC FinTech Week, and Bloomberg is on site. Live from Washington, Kaylee Lyon speaks with Grayscale CEO Michael Sonnenschein and others. Tune in for a special one-hour episode of Bloomberg Crypto. Bloomberg. Context changes everything.
The fraud was on behalf of the court. The court was the fraudster in this case. They made references to assets that were very valuable, because it's a scam. And this is a case that should have never been brought, and it's a case that now should be dismissed.
The former President Donald Trump speaking to the press after testifying in his New York civil fraud trial. This all ahead of the 2024 elections, where a recent New York Times poll has the former president leading Joe Biden in 5 key swing states. Live from New York City, welcome to the program. Your equity market on the S&P 500 shaping up as follows, with negative 0.25% on the S&P. Yields a little bit lower by a couple of basis points on a 10-year, 462.45. Moments away, Bramo, from a conversation with the Minneapolis Fed President Neil Kashkari.
To try to understand how the Fed feels about the easing in financial conditions that we've gotten since the Fed press conference with Chair Powell. Is this a problem? Does this set them back? Suddenly, the bond market isn't doing the work for them. And does this create an issue, or is it fine, as you've pointed out, John, because the economic data is softening to the extent where they are comfortable with easier financial conditions?
Great follow-on guest after this conversation too, Neil Data Renmack, who is basically asking that question you alluded to, whether this Fed can be more tolerant of the easing of financial conditions we've seen over the last week. And they've eased big time, looking at equities, looking at bonds, fixed income, treasuries, credit, looking at foreign exchange as well, the dollar a little weaker.
So here's the conundrum that I think a lot of people are struggling with. On one hand, the stock market is not the economy. The stock market is the biggest companies that are doing really well. Smaller companies are not, and you can see that in the Russell 2000. So at what point are Fed officials taking their cues from some of the community meetings that they're having with business leaders that are telling them, we're really struggling between inflation and higher financing costs, and saying, okay, well, if things get easier, it's fine. But the big companies that have locked in some of those maturities are doing fantastically. And so you can go all in the stock market, even if you see a real concrete weakening in the real economy. And I think that's sort of the complexity that a lot of people are trying to wrap their heads around.
Don't we see stories like that right across the country right now?
Exactly. That's
you can say to them, unemployment's still low. Look at the equity market. Stocks are up. Look at the S&P 500. Look at select names. Apple, Tesla, Meta, Facebook, take your pick. Ask them how they feel about this economy. Doesn't reflect that, that's for sure.
And if you look at just the tangibles of what people are paying for groceries, of what small businesses are having to pay for salaries in addition to their fixed costs, it raises this question about whether their fate is being accurately reflected in the broad stock market, the S&P 500. And so, again, I just wonder if the Fed's going to listen more to that than the equity market. And in some ways, in a counterintuitive way, this speaks to Ben Laidler's Fed put coming back into play, not because they want to rescue the stock market, but because they're responding to a different market, the economy, that looks very different.
Can you imagine how difficult it is to run a business right now? We used to have these problems in the restaurant business in my family for a long time. I can't imagine how much harder it is now, given how much more expensive things are at the moment.
I actually was speaking with a restaurant owner recently who's a friend of mine who was talking about how much more they have to pay, how much the fixed costs of food have gone up, that they need to get a greater number of people in, and that means they've got to pay the higher rents. So if business falls off at all, they have no safety net, and they can't borrow to offset that in the near term, even if business falls off for a couple of weeks, because they'll be hemorrhaging cash because the rates are too high. This is the kind of calculus going on Main Street, whatever you want to call it, that big businesses are not grappling with.
Joining us now to discuss, Bloomberg's Anne-Marie, our chief Washington correspondent down in D.C. AMH, let's start there. It's a national story. Is it a local issue when we face these elections a little bit later?
Well, absolutely. What you're seeing time and time again when you poll the American people, especially as polling has really ramped up because we have a presidential election next year, is that time and time again, the economy rates number one on top of mind of American voters. And when it comes to the economy, and even though we are seeing good data when you look at what's going on in the jobs market, the fact of the matter is Americans are still concerned with inflation. the price of everyday consumer goods, grocery prices. You were just talking about what's going on at restaurants and the cost of those kinds of goods. That pushes up your bill when a family is dining out, either a single person, a family of four. Everyone is feeling how much more expensive it is. So potentially you can see in some of these off-year elections, is there any sort of referendum against what is going on here in Washington? But of course, there's a lot of single issues that are also being fought on these ballots, abortion being one of them. In Ohio, there's going to actually be an initiative to enshrine abortion into the Constitution in Ohio, into their state constitution. So it's going to be interesting to see the results of this and what potentially they can tell us in terms of reading the tea leaves about next year's general election.
How much are you looking into what's happening in Virginia as a referendum and whether Glenn Youngkin will be the Republican nominee?
Well, Terry Haynes of Pangea Policy says ignore everything but what's going on in Virginia, because what happens in Virginia means it could potentially be a future Republican president. So there's a lot of discussions, and we've seen all the reports that donors are cozying up to Glenn Youngkin and begging him to jump into this 2024 presidential election. But he has this governorship in Virginia till 2026. Due to the law in Virginia, he cannot serve or run for 2 consecutive terms. So he would end at 2026, and it gives him the perfect timing to then launch a 2028 presidential run. And potentially that's the path he may take. But let's see what the results show this evening. He has worked really hard with local legislatures to make sure they try to keep the state delegates, the House of Delegates of Virginia, red, and to try to flip the Senate red. If he's able to turn Virginia red, that sets him up nicely for whatever path he wants to take for his higher political ambitions.
How much time is there left to change the ticket between President Biden and former President Trump, the presumed nominee for the Republicans?
I don't think there's an exact deadline, but it's getting very close in terms of, so if Glenn Youngkin were to jump in, he's not going to be on Wednesday's evening presidential debate in Miami, the Republican debate in Miami. That's tomorrow. So there is some leeway, but I would say by the end of the year, if he was to get in, he would need to make that decision ASAP for starting of next year. Because for many people in D.C., it feels too late. But when you speak to people outside the Beltway, they say there is still a path. It's a very odd election year, to say the least. The clip we just showed coming into this was a former president testifying at a civil trial in New York State. So there could be potentially these wild card or black swan moments.
And yet he's the leading candidate for the party. And at the same time, AMH, we have a sitting president who's running for a second term, who people are still questioning whether he will run at all. What does that say about his prospects of winning?
Well, it's going to come down to these key swing states, which is why people are concerned when they look at the New York Times Siena poll over the weekend, or they saw our Bloomberg News Morning Consult poll, which showed that Trump is winning in key states. You have to win these key states or you lose the Electoral College. There's one caveat, though, in that Siena New York Times poll, and that is the fact that these voters say that if Trump is convicted, say, on the January 6th related trial in Washington, D.C., this felony trial, then they would switch their vote to President Joe Biden, even though many believe that the current president is just too old. They're not feeling the effects of Bidenomics, which we see him trying to transition this week and tout like he was talking about Amtrak yesterday. But the fact of the matter is, if there is a conviction on this president, that is potentially going to change these poll numbers very quickly.
Mace, just quickly, Bidenomics, what does that mean to the electorate? What does that word mean?
Well, it's not polling well, Jonathan. And there was a Washington Post poll done a few months ago when what you saw is the majority of individuals that were asked about Bidenomics, they couldn't explain what it meant. They couldn't explain parts of the Inflation Reduction Act that this administration likes to tout. This administration, when they talk about Bidenomics, they really point to 3 key legislation they were able to get through. One, hard infrastructure, which used to be a joke under the former president. Every week used to be Infrastructure Week. And this is why Biden yesterday was touting it. I actually got it done. We are putting $16 billion into Amtrak. Why are our railroads in America not as good or up to speed as those you've seen around the world? And many people can attest them if you've taken a train in Switzerland or if you've taken a train in Japan. Then they'll point to the Chips and Science Act. Then they'll point to the Inflation Reduction Act, which goes heavy on climate change, tax credits for EVs. The issue is when you have inflation that is still eating away at families' paychecks, this kind of stuff is just not landing.
Swiss trains getting so much love this morning. That's the second time already. AMH, thank you.
They're great.
They are great. I mean, they're pretty decent, aren't they? It's amazing.
I love trains. I want to love Amtrak.
I can plan a trip with a Swiss train a month out, and it can tell me which platform I'm going to leave from, and then if I get a connecting train, which platform that train's going to leave from, and it's going to leave exactly on time.
Perfectly on time, and it's clean, and
like
it's lovely.
Like a Swiss watch. It's
right,
a beautiful
exactly.
thing. All right. Neil Kashkari up next. Six-day winning streak on the S&P 500 could be coming to a close. Equity futures this morning slightly negative on the S&P 500, pulling back by 0.25%. 7 days on the Nasdaq. 7-day winning streak on the Nasdaq 100. We're down about 0.1% on a session so far. Into the bond market, 2-year, 10-year, 30-year, 10-year, 463.70. Yields aggressively lower last week, a little bit higher yesterday. And Bramo this morning, just a touch lower on a 10-year maturity.
That basically is flat. That basically is no motion whatsoever. And just wait a second. And at 1 p.m. we get those auctions, and maybe we'll get a new tone, a new narrative that we can lean into.
Can we talk about one single name before we move on? From $47 billion to bankruptcy, WeWork. We mentioned this about 90 minutes ago. If there's a winner of ZERP, is it Adam Neumann or is it Adam Newman? Wow.
There are so many great poster children, but he really does take the cake in terms of having a company built on philosophy that in the nuts and bolts is basically getting 10 to 20-year leases for properties at 750 buildings and then renting it out by the month. And suddenly the office market collapses. And that is what you're seeing today, especially at a time where I believe they've got $19 billion of debt and a valuation currently of assets of about $16 billion.
Amazing. Just amazing. Full coverage of that on Bloomberg TV and radio throughout this morning. This morning, Mike McKee, drum roll, fantastic guest around a table with us to talk about Fed policy.
Yes, and thank you very much, John, because we are pleased to welcome Neil Kashkari, the president of the Federal Reserve Bank of Minneapolis, to the table today. Thank you for coming in, making the trip all the way to New York, only for us, I'm sure.
Nothing else, Mike.
Nothing else. There would be nothing else this morning, and except for Bloomberg surveillance. You're kind of known as the guy who is the most hawkish. I don't want to characterize you exactly now, given how things have changed over the last couple of months, but you have left open the possibility of doing more. How much more would you think the economy might need? Are we talking about just that one leftover move from the dot plot in September? Or if you have to start raising again, do you have to go farther probably?
Well, first of all, it's great to see you. Thanks for having me. People are looking for certainty, and I wish I could give that certainty, provided. There's been so much that's unusual about the reopening of the economy and the dynamics that led to the high inflation and how long it has taken and the dynamics as the disinflation process has taken hold. I wish I knew. We have to let the inflation data guide us, the labor market data guide us. You know, just to point out the obvious, our forecasts have not been great over the past couple of years. And so we just need to, we're all committed. Everybody on the FOMC is committed that 2% is our inflation target. We have to get inflation back down to 2% over a reasonable period of time. Ultimately, the economy will tell us how much is needed to get there. And I just don't know.
Well, at what point do you think you would believe you have tightened enough or not tightened enough? What is it that you're looking for?
Well, I'll give you some good news is that core PCE on a 3-month basis is running about 2.5%. And it's lower than the 6-month data. It's lower than the 1-year data. So that suggests that the disinflation is real. If we continue to see inflation numbers of that range, 2.5% or lower on a go-forward basis, that would tell me, okay, we are now on a path back to 2% inflation. But 3 months data is still only 3 months data. And if we see that start to tick back up again, that would tell me our job is not yet done.
Tick back up means what? In other words, we get another couple of CPI reports and a PCE report before your next meeting, a couple of tenths higher. The chairman and others say it's going to be lumpy. Or does it have to be a significant move? In other words, what are you thinking about for December?
Well, I think we'd look at, as the chairman always says, we look at all of the data. So what surprised us over the past few months? We've been surprised by how strong American consumers have been. Consumer spending has held up remarkably well. We've been surprised by GDP growth. When activity continues to run this hot, That makes me question, is policy as tight as we assume that it currently is? So if you saw inflation tick back up and you saw continued very strong economic activity on the real side of the economy, that would tell me, okay, we might need to do more. So it's hard for me to say this one data point needs to be here. I would be looking at the suite of data.
Did we outsource doing more to financial markets in the last week? Have we outsourced doing more to financial markets?
You know, this is a very complicated question on what has been driving the long end of the yield curve. Some people point to term premium, and I always joke that term premium is the economist version of dark matter. It's the residual of all the stuff we can't explain. It's not that our models are wrong, it's the dark matter is out there. So that's the term premium, and some people say, well, that's driven by fiscal. If it was fiscal driving the term premium, I would have expected to see a weak dollar. Usually when investors are worried about a country's fiscal position, their currency weakens. Our currency has been quite strong. It makes me wonder, is it really fiscal driving the term premium? Another possibility is the path of policy over the next few years. That could explain both the stronger dollar and the weaker stock market going into the last meeting. Another one is that maybe the neutral rate is higher, or maybe it's a combination of all three of these. And so these are things that we're spending a lot of time trying to understand what the markets are doing. But just speaking for myself, I'm not comfortable saying which of those three it is, because which of those three it is determines what it means for policy. If it is the term premium, then it is doing some work for the Fed. But if it's the neutral rate or if it's the forward guidance of the path of policy, then we would actually have to follow through to preserve those rates.
So how did this line end up in the statement? And I'll share it with our audience, that tighter financial and credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. Where's that coming from?
Well, that's been there for a long time. I mean, that's been in there since the Silicon Valley Bank episode and the banking stresses leading to some tightening of credit conditions across the economy. So I think that that's right. I, for one, don't say that that means the recent moves in the yield curve.
How fluid is that assessment? Can that change from month to month, meeting to meeting? Because some of those comments around that has inspired quite a move in this market over the last week.
Well, you know, one of the things about the statement, we always have to be careful about putting things into the statement because they tend to be long-lived, and it's hard to pull them out of the statement because as soon as you take something out, then all of a sudden people say, oh my gosh, they're declaring that all the banking stresses are over, as an example. And so, you know, I would look at all of the range of commentary that you get, look at what the chairman says, look at his press conference to get a read of the thoughts of the committee.
You said that people want certainty and that you can't give it to them, and I understand that. But people don't just want certainty. They also want some sort of guiding philosophy. Do you think that Fed Chair Powell has outlined some sort of guiding philosophy on where the bar is to cut rates, on where the bar is to raise them further?
Well, I think he's articulated very clearly that we're committed to getting back to 2% inflation, right? There's been some chatter amongst economists that maybe we should raise the inflation target. I think he's done a great job saying that is not on the table. We're not going to do that. We're going to get inflation back to 2%, and we're going to let the data guide us. We've moved very aggressively. We've made a lot of progress on inflation. We're not done yet, meaning inflation is not back to our target, and if we need to do more, we will.
There seemed to be a feeling in markets that the bar to cut rates has been lowered over the past week or 2 weeks. That suddenly, not only are we reaching a pause, and have we seen a peak in the Fed funds rate, but that also the Fed will cut next year, maybe surgically. Neil Dutta is talking about that, and he's coming up next. Do you want to push back against that? Do you think that the bar to cut is still just as high as it was?
I have no idea where market participants are getting that. There's no discussion amongst me and any of my colleagues about when we're going to start preparing to cut rates. The only thing that's been talked about at all is that at some point, when inflation is well on its way back down, if we didn't back off a little bit, then real rates would be getting tighter and tighter and tighter. And that's real, but that's math.
But is there enough weakness currently in the market, in the economy, I should say, to give you that sense at this point?
Look at the last GDP print. I mean, does anybody look at that and think, oh my gosh, the economy, for the last 12 months, GDP has been very strong. The labor market continues to be quite robust. Yes, the unemployment rate has ticked up to 3.9%, but we've also seen a huge surge of labor supply, which is really positive, come online. So I'm looking at this. I'm seeing consumers that are strong. By the way, my airplane that I came here on was 100% full yesterday. It's going to be 100% full today. I'm not seeing a lot of evidence that the economy is weakening.
Well, whether you go higher or not, you are on board for longer. And so you must have modeled out some idea of how long you would need to leave rates unchanged before you could get down to a level low enough that you could take your foot off the brake a little bit. How long do you think you'll be at 5.5 into 2024? Well,
I think it's going to depend. If we continue to see inflation prints similar to the ones we've seen the last few months, and we end up with a year over year at 2.5% core inflation, and it continues to trend down, that constellation would give me evidence to say, hey, we ought to look at, should we start backing off, just so the real policy isn't getting tighter and tighter and tighter, because we're clearly on our way back down to 2%. But again, I don't want to just point to one data series. We will be looking at the suite of data to try to get a read of where the economy is headed.
Well, not just data. You talk to businesses in your district all the time. What are they telling you now about their view of growth and hiring and pricing going forward? It's
moderating. So the labor market is still tight in my district. People, especially in the Dakotas, really have a hard time finding workers. But in Minnesota, it's still a tight labor market, but it's not as tight as it was 6 months ago. It's not as tight as it was a year ago. So that kind of maps to the national data that we're seeing of a gently cooling labor market, but one that's still very, very warm. Same thing with economic activity. Depending on the sector, they're saying, hey, we feel pretty good about things. We're a little cautious about the future. Obviously, they watch the news. They read the news. There's a lot of economic anxiety that is reported on that people factor that into their own thinking and their own business planning. So I think the outlooks are still optimistic, but it's cautious optimism.
Well, are they still raising prices or think they need to?
So it's funny. They still, by and large, have some pricing power, more than they had before the pandemic, but not as much pricing power as they had 6 months or a year ago.
Can we finish on housing?
Sure.
In the space of 3 years, we've had record low interest rates and the highest rates in several decades. Is this housing market broken?
Well, I think since the pandemic, we have structurally underbuilt the number of units that we need to meet our growing population. And that's the factor. And that's really about regulation at the local level that are creating barriers to more supply coming in. The rate environment will settle out over time. But structurally, we have to actually bring a lot more supply online to meet Americans' needs.
You say over time, but it could be like 20, 30 years. I think this is the issue here. The legacy of this FOMC could well be a generation of people locked out of the housing market.
Why do you say that?
There could be a generation of people with 2-3% mortgages that never sell their home.
Yeah, I don't know. People end up needing to move. It's funny, when people don't sell their home because they're locked into a low mortgage, that's less supply, but that's also one less buyer. Most people who buy homes are leaving another home. And so that affects both the supply side and the demand side of the housing market.
Which is why I said a generation locked out, because I'm renting and can't buy. So I'm not selling anything. Yeah. And that's the generation I'm talking about. That generation specifically. Are you concerned that could be the legacy of this FOMC?
No, I think the legacy of this FOMC is that we've dealt with the pandemic very aggressively. Then we were surprised by very high inflation, but then we moved very aggressively to bring the inflation back down.
I want to ask you about a story on the Bloomberg terminal today about all the financial CEOs from the U.S. over in Hong Kong sounding very dour and down about the prospects for the economy. They suggest that things are pretty fragile right now, both in the economy and the markets, given everything that's going on around the world and in the shadow banking system as well as theirs. How worried are you?
Well, I mean, we're always worried about things that can happen all around the world. We've got teams of people looking at different scenarios around the world. Ultimately, we have to focus on what we can control. Geopolitics, when Hamas attacked Israel, the first thing we thought of is what's it going to do to the oil market? What's it going to do to commodity prices? Remarkably, the response so far has been muted, but that's something we're obviously paying close attention to. But the broader geopolitical issues are just so far outside of our bounds of forecasting. We have a hard enough time forecasting inflation. Trying to forecast where geopolitics is going, we just have to focus on what we can control.
Oil prices dropped, Bramo. I mean, that's the crazy thing about the last month, isn't it?
It doesn't make any sense. And this is the reason why trying to get it right is just impossible. And then trying to get the idea of a Fed put and whether they're going to respond. I'm just saying, people are talking about that now. So
We've been talking about in the last few hours.
Yes,
this morning on this program. Neil, always a pleasure.
Thank you,
sir.
for having me.
Neil Kashkari, the Minneapolis Fed president, alongside Bloomberg's Mike McKee. If you are just joining us, this coverage is going to continue. We'll pick up on some of the comments from Neil and catch up with Renaissance Macro's Neil Dutter. Look out for that conversation in just a moment. Equity futures on the S&P 500 pulling back just a touch by 1/3% following a 6-day winning streak on the S&P 500, 7 days on the Nasdaq 100, the longest winning streak on the Nasdaq going back to January. Over that period, we've had a gain of more than 7%. Are we confusing bond market stability with the bond market rally? I don't know. We can talk about that too. Yields lower by a single basis point on a 10-year, 463.28 from New York City this morning. Good morning.
We have to let the inflation data guide us, the labor market data guide us. Just to point out the obvious, our forecasts have not been great over the past couple of years. And so we just need to, we're all committed. Everybody on the FOMC is committed that 2% is our inflation target. We have to get inflation back down to 2% over a reasonable period of time. Ultimately, the economy will tell us how much is needed to get there. And I just don't know.
Neil Kashkari, moments ago, the Minneapolis Fed president on Fed policy. This conversation is going to continue in just a moment with Neil Dutter of Renaissance Macro. Before we get there, just to check in on some of the scores right now in financial markets. Equity futures a touch negative by 0.25% on the S&P. Yields a touch lower by a single basis point, 462.87. The dollar a little stronger against the euro, 106.83. That currency pair negative here, Lisa, by about 0.3%.
I thought it was interesting that Neil Kashkari was talking about the dollar and the strength there, sort of kind of raising doubts about this story that the yield increase was really due to the increase in the debt, increase in deficits, increase in anxiety around the U.S. political system. That was interesting to me, that normally you would see the dollar weaken. And the fact that we haven't makes him sort of question whether this is a supply-driven story. I might push back that the rest of the world looks even worse. So there is that sort of issue. But, this has been one of the big conundrums.
Given the position they're in, they cannot talk about rate cuts.
Yes.
They can't even imply that they're thinking about rate cuts. And that's a conversation we need to have right now with Neil Dutter, the head of US economic research at Renaissance Macro. Neil, good morning to you.
Good morning.
Let's go straight there, because my IB was lighting up with messages from you. We're not thinking about tapering 2 months later. We're a long way from neutral, cutting a month later. What do you think is going on within the FOMC? Where do you think this is going?
Well, I think I agree that it doesn't pay much to forecast right now. It's important just to look at the data as it's coming to you. And so I do sympathize with that. But at the end of the day, I mean, the unemployment rate is up above the Fed's forecast for this year. And that's the first time that's happened since March of 2022. Now, when you're in the thick of it, it's hard to know whether that represents the start of something much more onerous or whether it's just the normalization of the labor market. But I think for the Fed, I think the doves on the FOMC, and remember, President Kashkari, he tends to lean on the hawkish side of the consensus at the Fed. I think for the doves, they have all the ammunition they need to basically put the hawks in a casket. Okay? I mean, I think that's the way I would think about it. I mean, you can point to the pickup in productivity and what that's done to unit labor costs. You can point to what Powell has said, right? I mean, when central bankers use proceed carefully, risk management, that's code for doing nothing. And, finally, I mean, the employment report was probably understating payroll growth. That's my view. I mean, there was a lot of strike activity and so forth. But at the end of the day, average hourly earnings are running just over 3% at an annual rate over the last several months. So I don't think the hawks on the committee, frankly, can use the labor markets as a rationale to be hawkish anymore. So that is over. And so I think the doves can basically say that the labor markets have been rebalanced. And if they can say that, just implicitly, it means that the door is a little bit cracked open for a cut. And, the point I'm making to you is, Jay Powell, it wouldn't be the first time he basically, flipped on a dime. I mean, we're a long way from neutral. I mean, a few months later, he's cutting rates. We're not even thinking about tapering or hiking. And then we're hiking and tapering basically in the same month. So, to me, the fact that they're not talking about it is irrelevant.
It's also in their SEP for next year. The question is whether
surgical cuts. What are surgical cuts?
Basically, a few cuts to stabilize the economy. I mean, I think the issue is the extent to which cutting quickly translates into rapid economic stabilization. So, I mean, as an example, I mean, let's see what happens with mortgage purchase demand over the next couple of weeks. We've seen mortgage rates basically come down to, what, like 7%?
Okay, wait. I'm trying to wrap my head around this. 6 months ago, you were talking about way more economic strength in the U.S. economy than people had expected. Now you're talking about strategic or surgical cuts by the Federal Reserve to stabilize the economy. Are you saying that they are warranted because the economy
No, I don't think that they are. Part of the tension,
expected?
Lisa, is that my job isn't to tell people what I think the Fed should do. My job is to try to get into their head and figure out what they will do. I mean, if I was there, I would probably be more hawkish than the consensus on the FOMC, but I'm not there.
Well, but does this mean that you think the consequence of surgical cuts to fortify the economy will be prolonged inflation?
Yes.
Okay, so then how do you sort of arrange around that? Sort of what is the inflation rate? How do you sort of lean into the rally that we've seen in the bond market and say, wait a second, you guys have gotten ahead of your skis based on the game theory that the Fed is playing and the way that they're likely to do surgical cuts?
I don't know that the bond market's getting ahead of itself. I think the bond market is sniffing out that the distribution of risks have changed. I don't know what the Fed may do next. I mean, that's what I think the bond market is doing, and I think bond market investors are right to do that because, as I say, you think about it basically three prongs, right? The labor market, inflation, and then financial conditions. If the Fed can look at the labor market and say the labor markets are rebalanced, okay, that's check, done. You can't use that anymore as a reason to be hawkish. So, if anything, if the unemployment rate's now going up a little bit, the distribution of risks are that they would cut because the labor markets. And right, if the labor markets are thawing, that's going to give them increased confidence that inflation will thaw. And then finally, if that's the case, they're not going to be particularly concerned about the easing in financial conditions that you've seen since in the last week.
Which is what we've been talking about through this morning, whether they are going to tolerate the easing we've seen over the last week, and it feels like perhaps they will. Help me, work with me here. It feels like to me that you believe the world might have changed post-pandemic versus pre-pandemic. Do you sense that they still believe we're still in the same old world pre-pandemic?
I do. I mean, if you listen to someone like New York Fed President John Williams, even Chair Powell, I mean, there's quite a bit of reluctance to just say that, neutral rates are higher. I mean,
why do you think that is, Neil?
I don't know. I mean, I think that maybe in their mind, things haven't changed. I mean, you saw Powell talk about this at the press conference last week. I mean, if we get a pickup in potential growth, it's a temporary pickup in potential growth, then we'll go back down. So if you don't think that the world has fundamentally changed, then you're going to be more sort of cognizant of over-tightening risk, right? Like, so if the unemployment rate is starting to go up, you may have thought, well, maybe we overdid it. So you might be more willing to cut sooner as a result.
So are you more bullish on the U.S. economy, but also expect inflation to remain higher? And the Fed, when people look back, this will be considered a policy error that they weren't hawkish enough.
Yeah, I mean, I think that would be, that would be something I could be saying in 2025.
What would you point to if you had this conversation right now? And I would love to get you around the table next time with a Fed official to work through some of these issues. But what would you point to?
That sounds dangerous.
As the number one thing that indicates to you that the world has changed versus pre-pandemic, that ultimately they don't believe in? What would you point to?
Well, I mean, the first is let's look at the obvious. I mean, you've done a lot, and yet the economy is still kind of hanging in there. I would say that things like household formation rates are running twice the rate they did after the financial crisis. I mean, to me, I think it's much easier to tell the story about why the post-financial crisis period was actually the anomaly than not. So I think we're actually going back to the old normal, more so than anything else. Obviously, you think about all those people during the financial crisis period, or the years after it, that were saving up for retirement. A lot of them have now since retired, and they're now dissaving, which is, implies higher neutral rates. You think about income inequality. It was something that we were talking about all throughout the 2010s. Well, it's coming down now. People at the lower end of the wage spectrum are seeing more rapid growth in their wages. You see more increased sort of union activity, and unions getting big wins for blue-collar workers. I mean, these are not things, and those folks have a much higher propensity to spend. And so I think it's not right, in my view, to say that things haven't changed, but if that's what the Fed believes, then you have to be recognizing what that implies for what they might do later. And so I think just because they're not talking about cuts now does not mean they won't be talking about cuts in 3-6 months. That should be within the realm of possibility, and I think the markets, frankly, I'm not willing to fight the move yet.
Okay. Neil, a clinic, as always. You know you're one of my faves. I think everyone knows that. Neil Dutter of Renaissance Macro. Neil, thank you. Real clinic, Bramo.
Yeah.
That's ultimately the dividing line right now. The Federal Reserve, some people sense, still believes in the old world, that we haven't seen a big change.
I'm thinking about the hawks in a casket, and it's a very visceral image.
I know, it's pretty brutal.
It's pretty brutal. Seeing the dove sitting there laughing, I don't know if this is really the image.
Kashgari's waiting outside
but
Dutter.
In fairness, he's going to be one of the people. Anyway, let's move on.
Equities negative on the S&P 500 by 0.25%. Joining us shortly, Alicia Levine of BNY Mellon. In your bond market, yields just a touch lower on a 10-year Treasury this morning. Your 10-year yield at the moment, 4.63. From New York, this is Bloomberg.
If you talk to investors, everyone is still so bearish.
What we're seeing is a lot more focus on selectivity from our credit investors.
Doesn't look like inflation is sustainably slowing at this point.
What the market's telling you is that they're pricing some easing.
It's a matter of who's going to blink first. Is it the consumers or is it going to be the corporations?
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a fantastic morning already on this program. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market's negative by 0.25% on the S&P, but the last 30 minutes perfectly captures the debate in financial markets. Fed officials say no rate cuts are coming. Then you get a guest in the market turning around and saying, what, Bramo? Rate cuts are coming.
Saying basically every time they tell you that something isn't going to happen 3 months later, well, guess what? And that sort of seems to be what the market is betting. The key question is, how much is this a reprisal of the Fed put? How much is this in response to true weakness in the economy versus it's getting inconvenient to have tight policy when people are starting to actually feel pain? Remember, we actually had this conversation a long time ago, and then the pain never happened, so we didn't actually have to test the resolve of Fed officials.
The story of two Neils. Neil Kashgari of the Minneapolis Federal Reserve in the last hour on this program basically wants to remain vigilant. The risk here is that you still underdo things, that ultimately you need to have conviction that inflation is going back to 2%. Neil Kashgari, I won't use his language. I'll read what he wrote a little bit earlier this week, that ultimately the labour market is no longer a reason to be hawkish.
And that's basically what you're seeing priced into the market. How long were you practicing A Tale of Two Neils? I was sitting there, yes, I can imagine.
It's couple of seconds,
I think that's really
spot,
good. It was fantastic. It was really good.
Do.
It's sort of the morning of two Neils and the views that really are polarizing markets. Look, I think that also setting up the day with Ben Laidler talking about, the Fed put is back, and that is your insurance policy if things go south. Is that kind of what you're feeling in broader equities right now?
That's the bullish view, the hopes and dreams of a bull. Ben Laidler, a little bit earlier on this morning. Here's the pushback. Gone through this a few times, worth doing again. Marko Kolanovic over at JP Morgan, falling bond yields. Dovish central banks, take your pick. Knee-jerk positive for equities in the short term, but ultimately the growth policy trade-off will remain challenging into year-end. That growth policy trade-off's important here. You've got a Federal Reserve that arguably stays on hold into year-end, and growth, given what we saw in 3Q, that's going to be slower than it was in the third quarter.
So could you get very little pain and a Fed still potentially cutting rates? I mean, I guess that's essentially what you're looking at from the bullish hopes and dreams is soft landing, immaculate disinflation, and a Fed that adjusts to a less restrictive kind of way because they don't need to do that much more. It is head spinning. What we can see right now is the Fed has no clue. They have no way of guiding people because they don't know. They are watching the data as everybody else. And markets are still tied to this idea that essentially the Fed will not hurt them too badly. And that seems to be where we are this morning.
The comfort.
Yes, exactly.
The warm embrace of Chairman Powell. Equity futures on the S&P 500. Keep it together.
There's
futures
so many
on the
images
S&P.
this morning.
Don't.
The casket of
Get rid of those.
crows
Get rid
or
of
hawks
those.
or whatever.
Get rid of those. Equities on the S&P, negative 0.2%. We are a little bit lower this morning. Yields a little bit lower as well. Down negative, off by about 2 basis points, 462.66. Tons of issuance this week. We'll talk about it all through the week from the Treasury. This has got to become a mainstream story, Bramo. We've got to do our best to make it one. All the issuance coming from Treasury, all the supply, $48 billion of 3-year notes today. Tomorrow, $40 billion of 10-year notes. The day after that, $24 billion of 30-year bonds. That is a lot of supply that's going to hit this market.
And we haven't talked about supply for decades. And the reason why we're talking about it right now is because if it is not digested well by markets and yields go up, then all of a sudden it is more difficult for the U.S. to keep spending. And I think that that ends up in a political discussion because essentially interest payments in 2050 will equal something like 8% of total GDP if rates remain where they are. So if you start looking at that kind of math, it's really deeply uncomfortable politically versus people going back to lower rates, and then you can make this sustainable for a very long time.
I'm waiting for the day when the White House press secretary opens up the briefing with a yield on a 10-year.
It may happen.
You know?
Let's work toward that.
And then you get all these DC journalists trying to ask questions about the bond market. It could be a few years away. We'll see.
I think we should try to make that happen.
Who knows? Alicia Levine, Head of Investment Strategy and Equity Advisory Solutions at BNY Mellon, joins us around the table. Good to see you, Alicia, as always.
Great to be back following the two Neils.
The two Neils and Alicia. There we go. We've got a band. Have we opened the door for a year-end rally?
I think we have opened the door. There's clearly a market clearing price in the 10-year. And that's a little bit above 5%. And that's essentially, I think, where our ceiling is here. And you've seen trying to get above 5% comes down, bats down again. That's the market clearing price. That's where you get demand. And I think with that knowledge, you set up into a year-end rally. I will say this. I think the geopolitical risk out there is still somewhat, the left tail's growing. But ultimately, the fear and loathing in this market has been about supply and yields. And what we learned last week, the market clearing price is going to take care of that.
Pushback, 2 points. I mentioned Marko Klanovic over at JP Morgan. He's stressing, emphasizing the growth policy trade-off will remain challenging into year-end. Mike Wilson, Morgan Stanley, bearish all year. We find it difficult to get more excited about a year-end rally. What do you say back to those guys?
So first of all, it's been impossible to project anything in this weird environment. Because even if you got inflation right, sticky on the way down, Fed hiking more than expected in the beginning of the year, we're still up 14% year to date on the S&P. So let's talk about how the disconnect between financial assets and actually what happens in the fundamentals. So I think it's very rare to have two very negative years in the equity market following each other. It can happen, but absent a calamity, it's likely not to happen. Those are known risks, right? The fact that we have tightening, that the loan officer survey shows tightening, further tightening, and it's been going on for 6 quarters, that's known. Like, all the problems out there are known. And so in a weird way, it's a tailwind because the sentiment really is quite negative still. So it's not that they're wrong, it makes intellectual sense. I feel at home with that. But we have to invest client money in the real world and not just talk about it. And in the end, if you were underweight equities this year because you feared a Fed-induced massive recession and massive unemployment, you didn't make the year.
We're talking about equities as though they're a monolith, and yet the Russell 2000 really underperforming. The KBW banking index really underperforming. There are these spots that are more sort of hinged to the real economy that are really struggling. When you see a year-end rally, is it those areas or is it your usual suspects that have been doing well all year?
So look, we're talking about large cap America for the most part, which essentially means the S&P. Yes, those small caps are most exposed to the rate cycle because of the refinancing cost and the need for debt to grow. So the further down you go on the caps scale, that's where the risk is. So that's why we've seen such a divergence in assets. Having said that, to Neil Dutta's point, if the economy squeaks out here, there could be a massive rally in small caps because they've been decimated. I mean, the underperformance in small caps versus large caps this year is historic. And so that in itself is interesting because what we've seen, you turn the page, people tax loss sell into the year. It's the mutual funds in October. It's everybody else into the end of the year. And then you wind up with the reversion trade in January. So, I mean, it could be a great investing opportunity as well. It's not that we don't know that small caps are vulnerable. That's why they're priced this way today.
A lot of people are looking at the rally and saying it's because of the rally in equities and saying it's because we found stability in bonds. Is it stability? And John was asking this earlier. Is it stability or was it a rally, right? I mean, which is the difference? Is it enough just to have yields kind of bouncing around in a range that's below 5% and above 4%? And even if it's a pretty broad range, it'll be okay.
So that's a great question. The difference between stability and the rally. That's a great question, Lisa. I love it.
I stole it from him.
Okay, excellent question.
It's not as good now.
Yes.
Carry on, Alicia.
So, look, I think the issue is the stability. What we've seen is this year, the volatility in the bond market, less so the volatility in the equity market, which I think hit 13 at one point, which is shocking on the VIX. But it's the volatility in the bond market that's driven some of the risk-off behavior. You get stability there. You get some sense of pricing, maybe a ceiling on the 10-year. Let's call it maybe, okay? But I think the thought of 6-year yield, 6% yields seems less likely today than it did 2 weeks ago. And that's information. And that stabilizes the equity market.
Where do you want to be as that starts to evolve? So banks have started to do well. Consumer discretionary really beaten up over the last few months going into last week. Where do you want to be?
So I still think you have to be in large cap tech. Like large cap tech America is about growth without needing to borrow. So that's an important story. And that's part of the reason that this sector rallied so hard the first part of the year, because as the Fed was hiking, well, there's one group of companies that doesn't need to borrow, right? And they've got inherent growth and they've got a cycle coming up with AI. So you still have to be there. I like going into the sectors that are the most hated. It's often early to do that, but ultimately there's always a reversion in the following year. People are going to dump the losers into the end of the year. We've all seen this story happen. And then I think you can get in front of it. I'd say that for the most part, we are overweight U.S. assets versus rest of world. There's a really ACWI is 60% U.S., 40% rest of world. We don't do that, right? I mean, you have not gotten paid to be either in emerging markets or Europe. I'm sorry, Jonathan. Either for the last...
Not personal, don't worry.
The last 12 years or the last 30 years. We run data on this all the time. And while you can have great year or two of outperformance of rest of world assets, over time, long-term money, that's what we do. You're not paid being rest of world. So we're there because we need to be, but it's not really a diversification.
I remember when I first moved here about a decade ago, a guest came on the set and basically said on air, John, don't get me wrong, Europe's great for vacations, it's bad for investing. And that was basically the mantra for the next decade, and for what it was worth, I mean, it was probably the right approach.
How do you feel about being the ambassador for all investments in Europe? That people come on and they apologize to you.
I don't take it personally.
We're so sorry,
at all.
but we don't like
TK still thinks I'm paid in sterling.
He still thinks that you live there.
How long I've lived here for. Can we finish on this?
Yes.
The legacy of zero interest rates. WeWork, to go from a $47 billion valuation in 2019, well flagged, anticipated, but to learn this morning that it's gone bankrupt, have we fully realised the pain associated with everything we got up to in this market 10 years ago?
The poster child. The poster child, when money is free, what you can create and your negative cash flow can sustain a business with ever-increasing valuations because money is free. U.S. government has the same problem, as you've talked about earlier in this segment. Last year, net interest costs were $200 billion. This year, $800 billion, right? Low interest rates allow for a lot of spending. And in a sense, every balance sheet looked like a private equity firm. Deficit spending because you could keep on funding it. That's over. So the WeWorks of the world will be getting clearly a valuation cut, and the refunding is going to be difficult. So the areas we're going to see, obviously, commercial real estate, but again, not a secret. We know that. That's why some of the small and medium-sized banks are, the balance sheets feel traumatized right now, and probably static. But that story's not completely done. I don't want to paint a picture that it's all perfect, but I think we know where the risks are. Yeah,
there's a difference between the opportunity into year-end and the idea that we just haven't had the great refinancing yet. I just don't think we have. We can sit here and say Fed funds is 5 point whatever, but can you sit here and say that many people are paying it? We talked with Neil Kashkari about people being locked out of the housing market, sitting on 2-3% mortgage rates. So much of this, Bramo, still hasn't come to the surface.
In fact, you can actually look at borrowing costs that have gone down for corporate America over the last 2 weeks.
So corporate America and households have the same balance sheet, which is they can finance their debt because everyone's got debt at 3 to 4%, and they're making 5.5% on their cash. That can continue for a while, and that's why we haven't had the recession.
Alicia, it was great. It's good to see you. Alicia Levine there of BNY Mellon. If you are just joining us, welcome to the program. The S&P 500 right now, negative 0.1%. 0.2%. Yields a little bit lower by 3 basis points, 461.41 on a 10-year Treasury. Lots of issuance still to come. The 10-year, I believe, is tomorrow, Lisa. $40 billion worth of 10-year notes just around the corner.
Some people were saying that yesterday's sell-off came because there was a slew of investment-grade issuance. And here is my question. We haven't seen that refinancing wave. If we get stability in Treasury yields and suddenly people start to borrow, then do we start to see how many WeWorks there are out there? Because right now, I have no clue, right? I mean, WeWork is its own story and philosophy and situation that now has 750 properties they've got to deal with. But there's a question of how many similar types of debacles are lining up down the road.
Adam Newman. I mean, come on.
He had a vision.
If there's a bubble, buy it, that saying? And then get out, and he got out, didn't he? Except he was pushed out. That's what's amazing about the whole thing. I could talk about it all day. Greg Dacko of EY coming up a little bit later. Up next on this programme, Henrietta Trays of Vader Partners.
Americans focus on the economy. The economy is king. It's not only king, it's king, queen, and bishop when it comes to picking a president here in the United States. And that's going to be a huge factor in where people place their votes in November 2024. But as you all know, we are light years ahead from where that is in terms of assessing where the economy is going to be then. And that's going to be the major factor.
12 months away. Mohammed Yunus, the editor-in-chief over at Gallup. If you want to watch the full conversation, you can on Bloomberg.com. Well worth a second look. Mohammed Yunus and Gallup putting out this recently, and I think it's well worth a read. The two major political parties remain unpopular in the United States, with 56% of Americans viewing the Republican Party unfavorably, 58% saying the same thing of the Democratic Party. But this line here I think is really important that they're talking about over at Gallup. 53% of Americans believe the Republican Party will do a better job of keeping the country prosperous over the next few years, whereas 39% choose the Democratic Party. That's the problem for the White House into next year.
And that has been something that has been ongoing in terms of the perception of both parties. And there's one theory that, one party tends to govern when things are going well, and then the other one comes in when things are doing badly. And that's the offset that you get politically. But the real question to me is, what is the economic issue people are going to hinge on? Is it bringing down inflation? Is it going to be the debt? Is it going to be the international involvement or the local involvement? What exactly are people feeling if they still are getting raises at a significant proportion? And if you take a look at the overall economy, and Fed officials come on and say it's really strong. We just had Neil Kashkari come on and say he's not seeing weakness in this economy.
To be fair to Neil, we just had a quarter where we had GDP at close to 5%.
Exactly.
Who saw that coming?
But this is my point. And then people are saying the economy isn't strong and it's not going along. So what are people talking about when they're talking about the economy and economic strength?
They're talking about prices, and they're higher than where they were 4 years ago. You can't get away from it. You can talk about inflation. Maybe prices aren't climbing at the same rate as they were last year. But ultimately, if you're looking at your bills, you sit there and you assess things and you think about things personally. Not CPI when we put it out and look at how Wall Street reacts to it. You think about things personally. And people feel things are a lot more expensive now than they were 4 years ago before the pandemic. That's the problem they've got.
And at this point, it's unclear what they can do to fix that unless time heals all and we get a real disinflation or deflation. I mean, disinflation might not cut it by next year.
To Mohammed Yunus's point, the Fed can't project any of this. We can't forecast any of this 12 months out. So it makes it tremendously difficult to make any projections about the economy and about politics into next November. If you're just joining us, the equity market's slightly negative by 0.2% on the S&P 500. Bond yields a little bit lower by a couple of basis points, 4.62. Joining us now is Henrietta Trays, Economic Policy Research Director over at Vader Partners. Henrietta, let's just start with that poll that came out this weekend. New York Times, Siena College. Terrible reading for the sitting president. You expecting that to change anytime soon?
Well, what I really want to see is what the turnout in Virginia looks like and tells us where the polls are right and where they're wrong. One of the striking components of that New York Times Siena poll is that you're looking at a state like Nevada, which is historically very tight but reliably blue. And it suggests that pollsters are finding a 13-point swing away from Democrats and towards Republicans. I don't need to tell y'all, that is an enormous swing. Americans just don't change their minds like that. So to see that kind of swing is either an outlier. The polling is consistent with others that we've seen, but we're going to have a real opportunity to see whether that polling holds true in Virginia today, where there's House and Senate elections, and could potentially get Glenn Youngkin to decide whether or not he wants to jump into the Republican race and upend things even further. So I think we have something rare in D.C., which is like a real poll that we can watch in real time as an election.
All right, let's build on that, because people have been debating whether this is real, whether Glenn Youngkin truly wants to get into the running today or this year, or this particular running cycle, or whether he's going to wait until after his 2026 term ends. Do you think that today's election truly could determine and push Glenn Youngkin into the race?
Absolutely. I don't think there's a lane for him in the first place. If anything, Nikki Haley has usurped that by her strong showing in New Hampshire. But the three remaining realistic Republican candidates, if we include Youngkin on that list, so DeSantis, Haley, and Youngkin, if you jumped in, are just light years behind Donald Trump. So I think that it would be smarter for him to wait until 2026, get in next time around. But this is a signal that maybe he has an outside chance to win. And if there's a red wave, he's going to ride it, I would assume, and try to bolster his national credibility and maybe even just get in advance of the next cycle. But all pollsters and all close prognosticators in Virginia are anticipating that it's a Democratic win tonight, particularly late in the day as the votes come in later on Election Day. So I don't expect Youngkin to get in. I don't think it makes a lot of sense. I don't think there's a lane for him, but it is something that could very well happen as if the results are a surprise today.
The fact that we're even talking about it highlights how people are not excited about a matchup, once again, of Trump versus Biden. Do you think that it's truly realistic that one of the candidates on Wednesday's stage will rise to the occasion and take the place of former President Trump? Or do you think this is essentially what people are going to have, and this is what the landscape will look like next year?
This is what the landscape's going to look like. I mean, to say that there's a presidential candidate in all three first in the nation primaries running 31 points ahead of his next closest competitor is ridiculous on its face to think that it would be somehow a different outcome. So my expectation is firmly that it'll be Trump and Biden. And I think what you see in the polls right now is just discontent with both of them. And you have a huge chunk of independent voters and undecided voters who either won't participate or haven't decided or gotten comfortable with the idea that these are their only two options. There's still this holdout component.
Do Trump's legal issues matter?
I think what Trump's legal issues are doing is presenting him as very fiery and sort of engaged and excited, which is something that Biden notably lacks. That whole narrative about Biden being too old, despite the fact that the two men are just a couple years apart in age. I think what Trump is trying to do here is be combative, so it makes him look vibrant. And in that respect, it makes Biden look more lethargic, and that is probably the entire goal here. He's very likely to lose most of these 91 different counts, but the point is to present as aggressive and vivacious, and that's what he's doing.
I want to put together two stories. We've tried to do that over the last few weeks, Henrietta. The situation in the Middle East, and Israel specifically. There is always going to be division within any party over a single issue. There will always be an extreme fringe to the left or to the right. I want to talk about things to the left. Henrietta, how do you think this president is going to handle some of the pushback that he's seen from within his own party to his support that he has offered Israel following the terrorist attacks that we all witnessed on screen in rather graphic, tragic ways in the last month?
Yeah, I mean, I think all eyes are on Antony Blinken right now, and, certainly out there doing work across the entire region to try to at least stem what could be a massive escalation. I think the White House's position to strong-arm Israel behind closed doors has become increasingly more untenable, and they're going to have to go public with that. The atrocities are now seeping out into, I think, mainstream American news cycles, and they are atrocious on both sides. And I think voters on the left and on the right are having a really hard time with it. So my main question is, how long can Biden keep his anxiety or pressure system on Netanyahu in private, and when does it go public? And I think that's the next step here, and I wouldn't be surprised if that comes quickly. That's why they're trying to pass the government funding bill as fast as possible with aid to Israel, so that they can say, this aid is going to be contingent on X, Y, and Z. Let's have a ceasefire. You've got to stop the atrocities.
Lots to talk about into the end of the year. Henrietta, thank you. Henrietta Trey's there, Aveda Partners. The pressure building. Lisa, we've been talking about it now for the last few weeks.
And a lot of the headlines now are talking about how the U.S. is getting frustrated in terms of how much influence it has over Israel, even as all of the warships and the submarine with nuclear capabilities head to the Mediterranean. A real question on how much the diplomacy efforts have really borne fruit. And then on a political sphere, whether it matters at home, whether they're bearing fruit at home. It is a very difficult moment.
This is so complex. We don't need another armchair general, that's for sure. This stuff is so difficult and complex to get your head around.
And deeply emotional and polarizing. And it is clear, and I think you're right to say, we are seeing divisions on the left that are coming to the fore that are really deeply challenging for President Biden, especially heading into this election with certain swing states. I'm thinking of Michigan in particular.
We'll turn the focus back to financial markets in the next hour. Coming up in the next hour on Bloomberg TV, Jack Caffrey, JP Morgan, Jim Caron, Morgan Stanley, Laurie Calvasina of RBC Capital Markets. All of that coming up and a whole lot more. If you are just joining us, your equity market is slightly negative. We're down 0.25% on the S&P 500. Haven't seen this for a while. We've had 6 days of gains on the S&P, 7 days of gains on the Nasdaq 100, and in the bond market, yields are way off the highs, the multi-year highs that we had a little look at a couple of weeks ago, down from 5% to 462.24 on a 10-year in America. From New York City, this is Bloomberg.
An hour into the opening bell, a little bit of softness across the board. Welcome back. This is Bloomberg Surveillance. John Ferro's off to start preparing for his next hour. Tom is off. He will be back tomorrow. And we are looking at a real dearth of economic activity so far this week. We're not getting a lot of data after last week's bang up 1, 2, 3 punch that sent yields plummeting by 40 basis points. They are still lower, 4.62%, just off about 2 basis points. And you're seeing a little bit of sog on the equity indexes after a really robust 6 to 7 day rally, depending on the index, and a real question around how much we're seeing stocks and bonds reflect the soft landing scenario that a lot of Fed officials have been talking about. Earlier this morning, we did speak with the Fed president from Minneapolis, Neel Kashkari. He was talking about the need to do more. Michael McKee here with us, Bloomberg International Economics and Policy correspondent, who has given up his sleaze mantle after it didn't come out with anything particularly interesting. Why are you here? What is so interesting on a day of no real data?
I heard you were here, and I thought I'd come say hello. We do have some data.
All right.
The September
Try to
trade
sell
figures.
it.
September trade balance, $61.5 billion, which is a little bit higher than the $58.7 billion that had been initially reported. So on the margin, a slight take away from GDP, but not really going to move the needle there. And basically at this point, it's a dull week, as you mentioned, for economics. We have jobless claims on Thursday, and that's about it. So everybody's looking to the Fed. And the interesting thing is we got 11 speakers this week from the Fed, 17 speeches or appearances, and almost none of them, with the possible exception of Jay Powell on Thursday, matter because they're not talking about monetary policy, which means that our interview with Neel Kashkari, this is a long way of saying our interview with Neel Kashkari does matter to the markets.
I think that it does, especially at a time where he is one of the few hawks that are kind of pushing back against this idea that the Fed is definitely done and that the Fed is complacent. We aren't seeing much of a reaction to the trade data that we just completely de-emphasized in advance of this, so it's not that surprising. But you do see 10-year yields still lower on the day. I do find it interesting, though, that people are starting to bake in rate cuts and basically say that the Fed has reached a point where they are comfortable with the degree of weakening in the economy. How much is that borne out by the data? That you truly have seen in last week's data a softening in the fundamental employment and other outlooks that would justify this kind of shift in narrative?
Well, you have seen a softening in the data. You look at the unemployment rate went up. And a lot of people are pointing to the Atlanta Fed GDP Now numbers because they have maybe one number or two to put into their calculations. It's kind of ridiculous, but it does show a drop-off in the economy so far. Meaningless, but a drop-off. At the same time, the last CPI report, and we get another one next week, last CPI report on a month-over-month basis, prices went up. So they're still the Fed is still in this netherworld in between, demilitarized zone, whatever you want to call it, where they don't know which way it's going to go. And you characterize Neil as a hawk, and he's been a hawk, but now I think the definition is it's kind of hard to put a real label on people, because there are people who think we don't have to do any more and probably won't. And there are people who think we don't have to do any more, but maybe we will. And he falls in that latter category. He's not ready to give up yet, but he's not saying we need to raise rates again.
On one level, we don't have that much economic data this week. On another level, we have a lot. And that has to do with the auctions, $112 billion of Treasury auctions. How important will those be for Fed officials who are trying to understand where demand steps in and what kind of prices seem to be stable in markets at this point?
They'll watch with interest to see what the price is. The market's always clear. Neil and I were talking about that off camera. It's just a question of the price. And so what do people think they're going to have to pay to absorb all this paper? We're not just talking about $330 billion of treasuries. We're talking about $40 billion of corporates this week as well. So you got a lot of paper coming out that has to be bought by somebody. So what are they going to pay for that? But as you heard when Neil Kashkari was out here, the Fed doesn't think that fiscal issues are really what's driving the market. They have a day-to-day issue in the markets, but that it's probably more like the state of the economy and the state of where they think the Fed is going to go, short-term and long-term, with the neutral rate.
Michael McKee, thank you so much. And I did love Neil Kashkari's description of term premium as essentially the dark matter of economics, where it's everything else that we can't really explain. And parsing that out is something that is a feat of physics. Joining us now is a feat of physics, Greg Dako, chief economist at EY, here on set. And I want to start there, this question of, is the economy truly showing signs of softening to the degree that would support some of the moves that we've seen and this belief that the Fed is A, done, and B, poised for cuts as soon as next year?
Well, I think we are seeing some evidence that the economy is indeed slowing. The labor market has been the key pillar of resilience in the U.S. economy. We've started to see some softening. It's not the retrenchment that we typically see ahead of a recession, but it is evidence that employers are being more cautious with their hiring decisions. They're proceeding with some strategic resizing decisions, and importantly, they're optimizing wages. They're implementing essentially wage growth compression in an effort to limit cost. Because the key factor right now that's constraining the economy is this environment of cost fatigue. It's cost in terms of prices, in terms of wages, and in terms of interest rates. That is what is weighing down on the economy. The key question, though, is whether this continues and whether we continue to see this disinflationary momentum that would allow the Fed to hold put in terms of monetary policy and eventually start considering easing policy.
Do you believe in rate cuts next year? Does that make sense to you?
I do think there is the high probability of rate cuts next year. I think the key risk right now is that the Fed has, to some extent, delegated some of the tightening on the monetary policy front to financial markets. And in an environment where there is so much volatility in the data and where you remain extremely backward-looking in terms of your perspective for monetary policy, that's a key risk, because you're going to get these wild swings in terms of interest rates, as we've seen over the past couple of weeks. That's never good in terms of financial market stability. So I think what we need to see is more of a proactive and forward-looking perspective from the Fed to ensure that they take back the mantle in terms of guiding monetary policy and don't delegate that to financial markets.
All right, let's delve into that, because they have said higher for longer. What more can they say?
Well, they've said higher for longer, but they've also said that they're extremely data dependent. So 1 week, it's all good because the data is showing that spending over the summer was very good. The next week, because there's a slower labor market print, all of a sudden we're going to be easing monetary policy, or at least that's the signal that they give. Fed Chair Powell was given the opportunity last week during the press conference to reaffirm the hawkish bias from the dot plot, essentially that additional rate hike that is in the dot plot for the end of this year. He backed away from that. He did not say that the Fed was still open to further tightening. He said that the dot plot would decay over a 3-month period and that they were not a promise. So essentially, instead of reaffirming this optionality, he maintained the window open but did not confirm this desire to tighten monetary policy further. I think there's a bit of an issue here because they're implementing tightening via financial market conditions. That's actually a new word in the statement.
Right.
Financial market conditions are tightening. And at the same time, they're still extremely backward-looking. That duality is very difficult to comprehend from a market's perspective.
So do you think that that was a policy error? And I keep asking this question just to try to understand whether it's justified economically, and so everyone's going to run with it, and it's not going to be a problem for the Fed, even if financial conditions ease, like we've seen.
Well, that's the issue, right? The argument was that financial markets were doing some of the Fed's work, right? That we had seen a very rapid ramp up in long-term interest rates. Everybody was trying to understand why we came to the term premium as a potential reason for that increase in long-term yields. And now we've seen a retracement of about 40, 50 basis points over the course of the last 10 days. Does that mean that the Fed now needs to do more? Or is there an argument to say that actually, no, the Fed has done enough and that markets are pricing rate cuts today? That's the paradox that we're facing today. A very difficult exercise to plan when you're thinking about Fed policy. And that uncertainty is hurting businesses. Business executives that we speak to are highlighting this level of uncertainty as to where interest rates are going to be. Where is the cost of capital going to be next year?
And this is something that definitely has been underpinning the stasis that we have seen in a lot of corporate borrowing that's starting to thaw as we do have a bit of a rally. We're speaking with Greg Dacko of EY, and I want to delve further into this question of where we're heading to. And this was the debate that we had with Neil Dutta as well as Neil Kashkari. Where are we cutting rates to? Are we going back to what we used to know back in 2019, or are we in a higher inflation kind of environment? Do you have any conviction one way or the other?
Well, I think we're undoubtedly in a higher cost of capital environment, and we're likely to remain in a higher cost of capital environment for the foreseeable future. We know that central banks took the elevator on the way up. They tightened very rapidly in the face of what was unprecedented inflation for the last 40 years. Now they're likely to take the escalator on the way down. I think what's important, beyond the fact that they're likely to go gradually because they don't want to relent until they've won that battle against inflation, is the fact that they're likely to settle at a higher rate than was the case during most of the pre-pandemic era. They're likely to settle in an environment where short-term rates are around 3%. That means that long-term rates are also going to be in that 3 to 4% or 3.5% to 4% range for the foreseeable future. That is a new world to which the business world needs to adapt. It means that there are still investment decisions that make sense, but there needs to be much more scrutiny towards investments that have the highest return and focusing on productivity growth. We're hearing a lot more from businesses, from our clients, that are talking about how to alleviate cost pressures in this high cost of capital environment. And the key avenue is increasing productivity growth. It's not just a tech-driven play, it's a broad-based play driving stronger productivity via innovation, via processes, and via just more efficient workforce.
I think of the avocado at Chipotle, where they cut an avocado in half by a robot and then scoop out the core, and then somebody else does the actual mashing, and to try to increase productivity. To your point, this is the kind of stuff that people are doing.
Yeah, and some staying power in the labor market, less churn, is also another way to drive that productivity.
Just quickly, is this all basically saying that the Fed put is still there? It just will only be taken out of the closet when there is a little bit more pain, and you will see the Fed come in, cut rates, and support market valuations and corporate balance sheets?
Well, I think what's being priced in right now is this environment that is perfect, essentially a soft landing where monetary policy is gradually eased over the course of 2024 because we are in an environment where inflation is returning back to the 2% target, because economic activity is not plunging, not retrenching, and because the Fed decides that the real interest rate environment is the most important and they want to recalibrate that to a more neutral stance. That is the soft landing scenario. That's the Goldilocks scenario. There is a high probability that we don't end up with that scenario, either on the upside or on the downside. And that essentially this pricing that we're seeing today of 75 basis points to 100 basis points of rate cuts next year, starting in the middle of next year, actually won't materialize because there might be a lot of shift in terms of economic activity going forward.
Greg Dacko of EY, thank you so much for being with us. Good luck today on the election day when all of us who have kids in public school no longer have them in school because they do not have school today. If you are just joining the program, you can see the S&P a bit softer today after 6 straight days of gains, up down about 0.2%. Not a lot of drama, as my partner would say. We're looking at euro weakness, a bit of dollar strength after quite a bit of euro strength, sort of reprising a bit of value after a significant fall over 10-year yields, 4.62%, 6.183% to the third digit. Right now, Michael McKee, I'm looking at the University of Michigan Sentiment Survey. Which of these data points are going to matter most at a time where at one point an increase in inflation expectations, torpedoed all market valuations, and then no longer had any relevance.
Well, it's kind of funny because, as Greg was saying, the markets are very sensitive to economic data now, and that will move around a lot. Their expectations as they come in. The Fed is definitely looking at inflation expectations both on a market basis and on a consumer basis. And so they are going to watch that, but they're going to want several months of it because both of the big consumer surveys have sort of their biases. I wouldn't call them flaws, but gas prices really move the Michigan survey. Jobs really move the Conference Board survey. So if gas prices are going down, maybe we see a little drop in what the Michigan inflation expectations are. But if those things start to get embedded and stay at a higher level, then the Fed is going to put that in the box with higher CPI and be worried.
I'm so glad you brought up gasoline. Thank you so much, Michael McKee, and crude, because coming up, we're going to be speaking with Nadia Martin-Wiggin of Svelland Capital on oil prices, on some of the tie-ups that we've seen in the shale patch and beyond, and a real question about what's next in an industry that had been left behind and suddenly is very much a hot trade. This is Bloomberg.
If we continue to see inflation numbers of that range, 2.5% or lower on a go-forward basis, that would tell me, okay, we are now on a path back to 2% inflation. But 3 months data is still only 3 months data. And if we see that start to tick back up again, that would tell me our job is not yet done.
That was Neil Kashkari, Minneapolis Fed president, speaking with us about an hour ago as he parsed through exactly what the deliberation process is at a time where nobody really knows where this economy is going. A bit of softness to the tape after a number of days of strength, a real rally last week. This week, sort of a rethinking around what exactly transpired, why yields went down 40 basis points on the heels of a trifecta of a number of weaker data points, a Fed that appears to be okay with being on hold, and less Treasury issuance on the long end of the curve. I want to take a look at a number of names that are moving ahead of the opening bell on the heels of earnings. UBS coming out. We were talking about this earlier with our own Guy Johnson. You could see those shares up about 3.2%. The focus being the consolidation efforts moving along, reaffirming some of the 2025 and 2026 goals, and talking about how it's going to bring the two units together while getting rid of about 2/3 of UBS's investment bank. Uber, this is kind of interesting. Shares lower now, 2.6% lower in pre-market trading before they were actually up after giving a forecast that topped analysts' expectations, talking about everyone still going around and ride sharing, ride hailing, food delivery business still strong. I'm going to dig through this and try to understand exactly why shares are lower, especially given the fact that going forward, they seem to be consolidating a lot of the market share. This is one aspect that third quarter revenue came in well below Wall Street's expectations. And this one, D.R. Horton, those shares basically flat. But to me, worse than expected quarterly orders at this home builder operator, given the fact that mortgage rates are so high and it has been dampening demand. A lot of the focus today has been on potential geopolitical risks, or I should say over the past couple of weeks. And everyone's been pointing to oil prices. Why have they not gone up, given that there is a sort of existential risk and threat that seems to be escalating every single day in the Middle East? Joining us now to help us understand what exactly to look for, Nadia Martin-Wiggin, director at Svelland Capital. Nadia, I just want to start there. What do you make of the fact that we're seeing crude traded on the NYMEX below $80 a barrel again today, despite what's going on in Israel and in Gaza?
Hello. Great to be on. I think what we saw last week is that Hezbollah and Iran, for right now, they're on the sidelines, right? They don't actually want to show an escalation of the war going on in Gaza right now. So that has taken off some of the risk premium. For the last 10 days, we've actually seen the implied volatility in the options market come down. So it's not even something that's happened just today. It's been for the last 10 days, that trend. I think in addition, when that premium, that initial shock goes away, as we saw was the case with the war in Ukraine by Russia, eventually, the market starts to think about how to work around that. And for example, we've seen that freight rates have gone much higher. And part of that is when you look at it, it's almost like a risk balancing that, okay, if we can't flow through the Suez and we have to go around, then let's de-risk ourselves if things were to take longer. And we see that the freight market has actually priced that in as if they have to avoid the Suez, which they haven't had to do. So as a result, things have come down also in the oil market.
Okay, so let's take a step back for a second, Nadia. If you're looking at freight producers that are already coming up with alternate routes that avoid the Suez Canal to avoid potential, or the Straits of Hormuz, to avoid potential blowback from Iran, does this mean that oil prices are actually higher than where they would be at this point if there weren't this geopolitical overhang, because it's actually being priced into the market in a material way?
Yeah, if we look at what was happening to the market in oil before the October 7th attack, we could see that prices were coming off, right? We had a lot of pressure on refinery margins. We had physical crude trading poorly. You know, we've had the largest overhang in the West African market that we've had in years. We had more than 25 million barrels unsold out of the November loading program. So we saw that kind of weakening. And then this is where the market would like to rebalance. And we saw the physical premiums come down for those grades, but the futures market has remained quite strong. And this is where we have to see that kind of rebalancing. When we look at kind of the momentum and what is happening to pure speculative traders, you know, the CTAs and so forth, that short-term momentum has been downwards, right? And that has put pressure, bringing us down to where we are now in WTI, you know, just above the 200-day moving average. If we look at that long-term momentum, it's still intact for a strong market, right? So there are still those longs in the market that we've had in since before all of this started. But again, the market is preparing in case something were to happen, because, you know, things had been ticking along well in the Middle East, and we were about to have a deal between Saudi Arabia, the US, and Israel, recognizing Israel, which would take off potentially a premium, right? And instead, we've moved in the opposite direction.
How much is the U.S. becoming the swing producer at a time where there is consolidation in the shale patch, and you are seeing companies try to realize the value from their stores, basically pump the oil while it's still valued in the world?
The deal of Exxon, for example, buying Pioneer, right? That really shows that they are focusing on the Permian, right? And what, interestingly, Exxon announced in their earnings call is that they believe that with their equipment and knowledge, they're able to bring in a total of 1 billion barrels of oil more out of those same assets than Pioneer was able to. So when we think about the terminal regular production rate in the U.S., you know, that goes from around 14.5 million barrels per day to maybe 15.5 million barrels per day. And the question is, when do we reach that, right? August production was 13.1 million barrels per day. It will probably take 2 years, but of course that depends on the short-term oil price and the signals, short-term meaning monthly, quarterly, and the signals that yields to shale producers in terms of activity, right? A weaker oil price will slow that down. A stronger oil price will speed that up.
So right now, given where prices are, do you expect more consolidation to be expedited currently, or do you think that people are going to wait until prices go up a bit further?
Prices are reasonably strong, right? The whole oil complex is in a good situation in making money. So what we saw at the start of October is that demand was starting to get hit, right? We had producers selling crude for more than $100 a barrel. And then we saw, for example, companies like India really complaining. Part of that is because Russian crude has continued to flow, and we had price caps breached, right? So you were paying more than $60 a barrel, maybe you were paying $70 a barrel, and then on average facing more than $100 a barrel was becoming difficult. So I think we've been in a pretty comfortable space, you know, in the $80 range for everyone to make money. So it makes it ripe for consolidation and valuable resources. We don't really need things to move much higher.
Do you think that, all things being equal, this is going to be the range for the foreseeable future just because of the pushes and the pulls that seem to be working in equilibrium?
From a technical level, yes, but of course, things can suddenly change very quickly, both in the Middle East, you know, towards a negative, towards a positive. So that can really shift things. And the number one thing to keep track of is that inventories were expected to quite steeply in the fourth quarter. And so far in October, they only drew on land around 300,000 barrels per day. So the market is waiting for evidence that actually we have tightness led by these supply cuts and demand isn't waning. Whereas, on the other hand, if it continues waning, then we could see further falls in price.
Nadia Martin-Wiggin of Svelland Capital, thank you so much for being with us. And right now I'm just looking at gasoline prices in the United States, and they have fallen from a recent peak in September of $3.88 or $3.88 to $3.40. So a pretty significant drop despite some of the geopolitical pressures outside of just simply gasoline that also have the refinery aspect in the mix. We're looking at crude that has come off quite considerably so far this month, so far over the past month, despite some of the fears about what's going on overseas. Coming up at Bloomberg TV at noon Eastern, don't miss this. On the heels of earnings, Uber CEO Dara Khosrowshahi joining to talk about the outlook for ride sharing, the outlook for how much wages have to go up for some of those drivers, which has been a serious issue, and consolidating market share at a time where that seems to be the trend versus Lyft. Also a question, of course, about how much people are going to pay as prices continue to go up. Prices of Uber shares lower by about 3% ahead of the open. Outside of Uber, we're looking at a bit of softness as people recalibrate after 6 straight days of gains, although less softness than earlier. S&P futures lower by just about 0.1%. Euro weakness versus the dollar, and 10-year yields, wow, they are now dropping even more, down about 4 basis points, reversing some of the increase we saw yesterday. Again, based on the volatility we've seen recently, this is basically no motion. This is Bloomberg.